A very good morning, friends. First of all, welcome you all to the classes of ICI Board of Studies. And I would be taking up the standard today with you and for the next 4 days as well. So we're going to start today with a very interesting and of course a very important standard from an examination point of view, Ind AS 115, that talks about revenue arising from contract with customer. So as I said, it's a very interesting standard, but at the same time, a very important standard. If you look at the past trend in the examination as well, the weightage of the standard has been pretty good. So I think we need to be very conceptually sound on this particular standard, not only from the examination point of view, but it's a very important standard from a practical point of view. Because every entity would definitely have a revenue, and the main concept of the standard is the recognition of revenue, the timing factor when the revenue recognition takes place. I don't presume any background on your part on this particular standard, so we'll start from a very scratch on this standard, and of course we'll take you to a good level on this particular standard. So let's begin the journey and let's start talking about Ind AS 115. Now, generally, I always have an habit, and this is pertinent to all these standards, and that is when I look at the name of the standard, I first of all like to look at the analysis of the name. So here again, I'm going to first of all look at the name of the revenue. The word is very clear, revenue, but it's just not revenue. It says revenue from contracts with customers. Revenue from contracts with customers. So we can see there are some important terminologies which are given in the name of the standard. But I think before I discuss those nomenclatures with you, the keywords in the name of the standard, let me first of all tell you something very interesting. There are a total of two, you can say, major accounting standard bodies in the world. So one of the major accounting standard bodies, as you know, is IASB, International Accounting Standard Board, which is basically setting up the international financial reporting standards. Then there is another major accounting standard body, and that's called FASB. It's called the Financial Accounting Standard Board, and it is basically, you can say, setting up the US GAAPs. So there are two major accounting standard bodies. One is IASB, that is the International Accounting Standard Board, and it is creating IFRS. And there is another accounting standard board which is called FASB, that is called the Financial Accounting Standard Board, and this is basically creating what we call US GAAPs. Now you must be wondering that why am I talking in terms of FASB and why am I talking in terms of US GAAP? Well, I think you might be aware, if not, let me tell you, that as far as the International Accounting Standards IFRS is concerned, they are largely supposed to be principle-based standard. Largely, they are supposed to be principle-based standard. Now, when we say that they are principle-based standard, which means that there is a lot of application in terms of judgment. Our Indian accounting standards are also on the lines of IFRS, and therefore the Indian accounting standard also involves a lot of judgment because there is an application of a principle-based concept and a lot of judgment is required. But if you look at the US GAAPs, they are largely supposed to be rule-based standard. They are supposed to be rule-based standard, which means lack of judgment. Which means it's a concept. They tell you that this is the formula, so you need to apply this, and it's more like a rule-based concept. Interestingly, imagine a product which gets created when two international accounting standard bodies, one is FASB, which creates a rule-based standard, and one is IASB, which creates a principle-based standard, and they create a standard which is created jointly. Trust me, IFRS 15, and we're looking at the corresponding standard Ind AS 115, is a product which is a joint research project of both the FASB and the IASB. So imagine a kind of a standard which has got created, which is a blend of a rule-based and a blend of a principle-based standard. This is only to tell you a little background about this standard. So the standard Ind AS 115, which is based on the principles, which is based on IFRS 15, is nothing but it's a byproduct of two major international accounting standard bodies, that is FASB and FASB and IASB. Now, having said that, that there are two international bodies creating this standard, and we've got a blend of a rule-based and a principle-based standard. Let me tell you that first of all, this Ind AS 115 is got something what we call a 5-step model. Now, this 5-step model is not something which I have created, because if you have attended my previous lectures as well, you would have realized that I'm in the habit of creating a step-by-step approach. But this time, this 5-step model is something which is created by the boards itself. So the standard Ind AS 115 very clearly, brings out that we need to apply a 5-step model in terms of revenue recognition. But before we come to that 5-step model, I think I just want to come back to the issue that I am first of all looking at the name of the standard. So let me now look at the name of the standard, and I see some very interesting terms in the name of the standard, which I think need a first reference. And trust me, friends, as we go along with the standard, please do one thing, do a cumulative revision of the standard as we progress. Like, for example, today's session is done, please go and revise it back. Once we do the second section, revise the first and the second one as well. Because generally what happens when the standard is a little bigger one, what happens, there might be little confusions if you don't revise. So I would request you that, you keep revising this particular standard. Trust me, at the end of the 5th day, when we're going to complete this standard, believe me, you're going to be very confident in terms of the standard. Terms and conditions apply. I hope you get that. Okay. So coming back to the name of the standard, there are 3 important terminologies, as we can see: the word revenue, the word contract, and the word customer. So I think I just want to draw a little attention to these 3 terms before we start with the 5-step model, which is given for revenue recognition. When I look at the term revenue, there is another term which comes to my mind, and that is income. Now, let me, I think, discuss this in a little more detail. So when I look at the term revenue, what comes to the mind is another term, that is income. So the first question what comes to the mind is, which is a bigger term? Is revenue a wider term, or is income a wider term? I think let's put across this question to you. Why don't you tell me and give me your opinions on which one is a wider term? Let's get this input from your side. A good morning once again to all of you. So what do you think, which is a wider term? Is revenue a term which is wider as compared to income, or is income a term which is wider compared to revenue? Okay, so we've got the inputs, I think, coming in from Manav. He tells me revenue is bigger. Let's get some more inputs from your side, friends. What do you think? Is income wider, or is a revenue wider? Because the name of the standard is revenue from contracts with customer. Okay, so I think I just got one input and more inputs coming in, and I think Namrata tells me income, Asha tells me it is income, and you are absolutely correct. One of the common kind of misconceptions we have is that revenue is a wider term. Let me remind you, friends, Schedule 3. In terms of Schedule 3, Division 2, if you would remember, we very clearly say that there is revenue, and then we say it is other income. We use the word revenue, then we say it is other income. We add this up, and we call this as a total income. This is to remind you the concept in terms of Schedule 3. Now, there is something very important which I'm going to mention at this stage. Hear me very carefully at this particular stage. So when I say revenue, the question rises, what is revenue? Revenue means something which arises from operations of the business. Revenue means which is arising from the operations of the entity, sale of goods, rendering of services. So when I say that you are getting a revenue from sale of goods, or you are getting revenue from rendering of services. So we can say that sale of goods and rendering of services, this is revenue which comes from the operations of the entity. But when we say that it is other income, the other income means which is not related to operations. So other income is something which is not from operations. It is not from operations. So it's not from the sale of goods. It's not from the rendering of services, but it could be something else. Like, for example, there might be a rental income. Like, for example, there might be an interest income. Like, for example, there could be, for example, a profit on sale of, let's say, a property, plant, equipment. You sold a machinery, you sold a building, and there is a profit on sale of that property, plant, equipment. It becomes an other income. So when we use the word income, income means it's comprising of both the components, a revenue which comes from the operations of the entity and the other income which comes from the non-operations. So let's say, for example, if you look at a company which is, let's say, dealing in garments, then the amount of revenue they are getting from the sale of garments is supposed to be a revenue. But let's say, for example, they sold a piece of land which is not related to the business of the entity, then the profit on the sale of the land is supposed to be other income. Now, the pertinent question arises, is Ind AS 1115 applicable only to revenue, or is it also applicable to other income? Now, caution friends at this stage. Per se, if you read the name of the standard, it says revenue. So it logically implies that this standard deals with the recognition. Mind the words, it deals with the timing factor for recognition of revenue arising from sale of goods and services. But this standard also applies to the timing factor for recognition of other income as well. The computation of the other income, for example, profit on sale, is going to be done as per Ind AS 16. Ind AS 16 talks about a property, plant, equipment. So if you're going to sell a property, plant, equipment, the computation of the profit or loss, all those things are addressed as per Ind AS 16. But the timing factor when the profit on sale is going to be recognized. So when do you recognize that profit or loss on sale of the PPE is going to be governed as per Ind AS 115. So it would be technically incorrect to say that this standard deals only with revenue arising from operations. So we can say yes, per se, it is dealing with the recognition, the timing factor for the recognition of revenue arising from the sale of goods. But as far as other income is concerned, the computation aspects are contained in other standards. But as far as the timing factor is concerned, it is addressed in this standard. I think let me make a note on that. So we can make a mention out here that as far as profit on sale of PPE is concerned, if you look at the computation aspect, then it is supposed to be addressed by Ind AS 16. But if you look at the timing factor for recognition, if you look at the timing of recognition, so when do you recognize this revenue, then it is addressed by Ind AS 115. But yes, having said that, per se, when you're looking at the word revenue, Ind AS 115 is dealing with the timing factor for recognition of revenue arising from the sale of goods and the rendering of services. Done. So this is the first term. I thought I'll just first clarify the difference between revenue and income. Next, the second term we can see in the name of the standard is contract. The second term we can see in the name of the standard is the word contract. Now, as we know that if you look at a contract, there are always two parties in a contract. So what are the two parties in terms of this particular standard? So I would say one is the reporting entity, which needs to recognize revenue, and one is the customer on the other hand. So this contract could be a written contract. This contract could be a oral agreement, or it could be as per accepted business practices. It is not necessary that the contract between the customer and the reporting entity has to be a written agreement. It can be written, it can be oral, or it could be as per customary business practices as well. Let's, I think, note it down. So the contract is between two parties in the standard, and the two parties in the standard is, one is, I would call it as reporting entity. One is, we're going to call it as a reporting entity, and the other is what we're going to call it as customer. So the contract is between the two parties. One is the reporting entity and one is the customer. And this contract this may be a written agreement, or it may be an oral agreement, or it could be as per customary business practices, or it could be as per customary business practices. So these notes, of course, will be shared with you, but I would say, request you can start noting it down as well, because when you're noting it down, then, the memory is a little better. We are able to understand and appreciate the concept a little better. Right, so we understood the word revenue, we understood the word contract, and now comes the third term, that is customer. Well, I guess as far as a customer is concerned, I will give you a little input, but we will do a little interesting case study on the word customer as well. I have a few interesting case studies relating to these three terms itself. Before we formally begin with the 5-step model on this particular standard, I have some very interesting case studies on the terms revenue and on the word customer. But before that, I can give you the third term as well, that is customer. So the question arises that who is a customer? Well, I would say the customer has got two characteristics. When you're identifying in a particular contract who is a customer, I would say there are two characteristics of a customer. Number one, a customer is the one who pays consideration. So if you need to identify, you can first of all apply the characteristic one, look at the entity or look at the individual who is making a payment of the consideration. So who pays the consideration becomes the customer, characteristic number one. Second, who consumes the final output? Who consumes the final output? If you sold something to the customer, you need to identify who is the entity or the person who's going to consume the final output of the reporting entity. So I would say in a given situation, when you're looking at a customer, you need to identify the two characteristics. Who is the person who is going to consume the final output of the entity? Who is the person or the entity who pays a consideration to the reporting entity? So theoretically, I think we have understood it well. I guess so. So let me just consolidate the picture right away to you before we take some case studies on these terms. So I have just given you three things so far, three terms so far. I've given you number one, that when you look at the name of the standard, it says revenue from contracts with customer. So when I look at the name of the standard, there are three terms which flash in my mind. One is the word revenue, one is the word contract, and one is the word customer. So when I think in terms of revenue, what comes to my mind? That this is revenue from operations. I'm looking at the revenue arising from sale of goods. I'm looking at revenue arising from rendering of services. So is the standard also applicable to the recognition, to the timing factor, recognition of other income as well? Yes. If you're going to make a sale of a property, plant, equipment, the computation of the profit loss is addressed as per Ind AS 16. But the timing factor, when this profit or loss is going to be recognized, is addressed by Ind AS 115. Then the word contract, there are two parties to the contract. So one is a customer and one is supposed to be the reporting entity. And in this particular case, it could be written agreement, it could be oral agreement, it could be as per customary business practices as well. And then we said that we are dealing with a contract with a customer. So who is supposed to be a customer? And I gave you two characteristics. We need to identify in a contract who pays the consideration. One, we need to identify in the contract that who is the person who is going to consume the final output of the entity, and that's going to be called as a customer. I think let's do one thing. Let's take you to some interesting case studies and you will give me an answer on that. So let's, I think, take you to one or two simple little questions on this area. I just added a few questions and this will also be shared with you. So let me just, I think, take you to the questions to begin. Just give me a second. This is the question. Yes. Let me just zoom this further and we can have a look at this. Okay, so I think we can, this should be pretty visibly clear, I guess. Let me see if this is visibly clear, I think. Yes, to me, I think it seems to be quite clear, I guess. Yes, let's begin the journey. Let me just read the two case studies. The first case study is given in the education material. The institute has released an education material. The Accounting Standard Board has released an education material on Ind AS 115. So I'm going to pick up a few questions relevant from our examination point of view for getting a more clarity from education material as well. So let me, I think, first of all, read the question to you. Let me, I think, just slightly make it out here. Okay, now let me read this. It says a company is registered as a EOU, that is export-oriented unit, and it exports all its manufactured products. The company is basically an export-oriented company. As per the foreign trade policy in India, merchandise exports from India scheme, MEIS, the company is eligible to claim 2% of the FOB value of the exports as export incentives in the form of scrips on 1st April 2015. So the company is getting an incentive, and that is an export incentive which is equal to 2% FOB value of the exports, and which could be used for payment of custom duty against the imports, or you could sold them in the open market. So these incentives which you are getting in the form of scrips, we generally call them as exempt scrips. These are called the export import scrips. So when the company gets these exempt scrips, it has got two options. Either it can sell them in the open market, or it could use them for the purpose of making a payment of import duty against imports. So you need to pay some custom duty against imports. You can use these exempt scrips, or they can be sold in the open market. Can this incentive be treated as a revenue or not? So I think let's put across this question to you. The question is pretty simple. There is a company which is exporting. It's basically an export-oriented company. So they are given an incentive under the scheme of Government of India. And you know what I mean. So they are given an incentive under the scheme of Government of India where they're going to get certain 2% of the FOB value of exports in the form of exempt scrip. So is this incentive which they're getting, is it supposed to be a revenue or not? Let's get your insights on that. So what do you say, friends? Do you think that this amount which you're getting in the form of exempt scrip, do you think we can consider this to be a revenue? Is it something which is linked to the operations of the company, sale of goods and rendering of services, or do we consider it some other way? Okay, I think we got the answer. Koshki tells me no, and Manav tells me it's other income, and yes, that is correct. Okay, can I put it like this, that this is a government grant? Can I say that this is given by the Government of India and there are certain conditions which the reporting entity is complied with, so it should be accounted under Ind AS 20? I think makes sense. So this is going to be not a case of revenue, but it's a case of a government grant, and Ind AS 20 would apply in this particular case. So I think I made a mention as well. In the given case, the export incentive is in the nature of a government grant, and it does not fall within the scope of 115 as it is not a revenue arising from contract with the customer. Such export incentives are benefits which are given by the government to incentivize the companies which are doing exports. Thus, while recognizing the income, the company should apply the provisions of Ind AS 20 and not Ind AS 115. I think makes complete sense. Okay, wonderful indeed. So this was one case study on understanding the definition of the word revenue. Let's look at another case study with you, and this is identifying a customer. So let's read the question number 2 with you. And I'm just going to read the facts. There are 2 parts to the question. So let's carefully read the 2 parts. This is again a question which I picked up from the education material itself. So let me just take you to the question number 2. It says C provides internet-based advertisement services to publishing company. So there is a company C Limited on one hand. It is providing internet-based advertisement services to publishing companies. It purchases the advertisement space on various websites from a selection of publishers as per the following scenario. So these are two independent parts. So there is a company C Limited. So what it does, it approaches the publishers where they purchase the space on their websites. Now, we given scenario number 1. It pre-purchases the advertisement space from the publisher before it finds the advertiser. For that space. Now, let's get the facts clear. There is a company C Limited and there is a publishing company, and these publishing companies are giving space on their website for advertisement. Now, what this C Limited does, it first of all pre-purchases the space from the publishing companies, and then they start looking for advertiser. Now, I'm going to give you the answer, I'm not going to ask you the answer in this. Does this mean that C Limited in this particular case is acting in its own self? Does this mean that C Limited is acting as a principal in itself? Yes, undoubtedly. When you are making a pre-purchase of the space from the publishing company, you are acting independently. So you're acting in your own right. You're acting as a principal. Now, let's look at the other one. In the second case, it says it provides the service of matching the advertisers with the publishers. So you are making both the people meet. So which party will be identified as a customer? Now, in the second case, it doesn't pre-purchase the space. What it does, it is arranging a meeting where it calls the publisher and it calls the advertisers and make them meet. It seems that he's acting more as an agent. So when you pre-purchase the space, you are acting as a principal. And when you are going to make the two people meet, then you're acting as an agent. Let me caution one thing, friends. If you look at Ind AS 115, there is a guidance which is given in the Appendix B. And the guidance in Appendix B tells us how do you identify that you are acting as a principal or agent. But it's too early to explain you the guidelines which are given in the Appendix B. Hear every word very carefully. So it's too early to give you the guidance in terms of that when does a company act as a principal and when does a company act as an agent. But we'll get into those guidelines later. But I think on a very apparent level, it is very clear that in the first situation, when you pre-purchase the space, you're definitely acting in your own right. You're acting as a principal. But when you make the two people meet, you're trying to match the services, you're acting as an agent. So indirectly, the question what comes to the mind is that when you're acting as a principal, who is the customer? And when you're acting as an agent, who is a customer? That's the pertinent question in this case. So as I said earlier, that there are two characteristics which would identify that who is a customer. Let me ask myself in the first part. When you pre-purchase the space from the publishing company, then who is the publishing company? They're indirectly my suppliers. When I'm making a purchase of a space from them, they're indirectly acting as a supplier. And ultimately, I sell this space to whom? To the advertisers. So who is the person who pays the consideration to me? It is the advertisers who pay the consideration to me, and they are consuming the space. So I would say when I'm acting as a principal, then the advertisers is supposed to be the customer. But what happens when you're acting as an agent in this particular case? When you're acting as an agent, then in this particular case, who pays your consideration? Is it the publishing companies who are acting as your principal? They are paying you a consideration? Yes. So I would say the advertisers would become the customer of the publishing company. And for C Limited, when he's acting as an agent for the publishing company pays the consideration. And we would say, therefore, the publishing company is supposed to be the customer in this particular case. So I would say that when you act as an agent, it would be technically correct to say that your principal indirectly becomes your customer. I repeat, when you're acting as an agent, your principal indirectly becomes your customer, because who is going to pay the consideration in this particular case? The principal pays the consideration. And I think needless to make a mention, why is it important to identify that you're acting as a principal or you're acting as an agent? Even if you apply your prior knowledge, you would know that when you act as a principal, then the revenue is always a gross revenue. But when you're acting as an agent, the revenue is only the amount of commission which you get. So it is very important, even for this standard, that you identify that a company is acting as a principal or is it acting as an agent. Because the revenue recognition, if you're acting as a principal, is a gross revenue. And when you're acting as an agent, the revenue which you're going to recognize is supposed to be only the net revenue, only the amount of commissions which you're going to get on the deal. I hope I'm pretty much clear on that. So these were the two case studies. One was dealing with the revenue part and one was dealing with the customer part. I've not put any case study on a contract. I think that's very well understood that the contract is supposed to be between the customer and the reporting entity, oral, written, or customary business practices, whatever. Okay, so this takes care of the initial discussions with you. So I am done with the name of the standard. I guess so far so good. Let me just get, are we completely comfortable so far, friends? Are we clearly understood with the concept so far? Just give me your inputs on that. I think there is a question which I think Shriram has got. So there is no contract between the government and the exporters as such. Hence, it cannot be recognized as revenue, rather recognized as other income. Okay, that was absolutely correct. Okay. So I think that seems to be pretty clear. I think Koshki tells me yes, clear. I hope my other friends also pretty much clear at this stage. Okay. So now let me start with the 5-step model with you. And I'm going to first of all give you a very basic introduction on the 5-step model. And then we'll start digging deep into each and every step of this 5-step model. Let's begin the journey. So I guess now it's time to expose you to the 5-step model. Okay, now hear me very carefully. I'm just going to give you a little insight on the standard. So let's begin the journey. So for those it's new, I guess new for most of you. So just hear me very carefully now. So what these standard setters have done, they've created a 5-step model on Ind AS 115. They've created a 5-step model in terms of Ind AS 115. As I said, it's a blend of a rule-based and a principle-based standard. So at the very face of it, they've created a 5-step model. Now, what are these 5 steps? The step number 1 is identify. The step number 1 is identify the contract. The step number 1 is identify the contract. Now, let me explain something. We'll get on to the details later, but this is just to give you a very basic flavor in terms of each step. Now, hear me very carefully. Now, in step number 1, when we say identify the contract, basically what you need to do, you need to identify that is it a valid contract or not. In step number 1, what do you need to do basically? You need to identify that it is a valid contract or not. This validity of the contract is not by way of law. We are not looking at the parameters, what law tells me that it's a valid contract. So you don't need to apply the Indian Contract Act. Caution. So when you're looking at the step number 1, you don't need to apply the Indian Contract Act and start understanding that is it a valid contract under the purview of law? No. So I'm generally in a habit of taking certain para numbers. You need not remember the para numbers, but this is just to give you the insight. In terms of para number 9, we are given 5 essential elements of a contract. We'll go through those elements very shortly. So the standard in para number 9 tells us that there are 5 essential elements of a contract. If all these 5 essential elements are present, it is supposed to be a valid contract. And even if one of the essential element is missing, it is not a valid contract. I said it very clear. So what you need to do in step number one, you need to pick up a contract. Like what we do in a practical life is we're going to pick up a contract with the customer and we're going to see that is it a valid contract or not? Does it contain all the 5 essential elements which are given in para 9? So if all the 5 essential elements are given, it's a valid contract. I can go to step number 2. If these essential elements are missing, any one or more than one element is missing, you cannot go to step number 2. This is the rule-based accounting. Then next, we go to the step number 2. In step number 2, we identify what we call performance obligations. In step number 2, we identify what we call performance obligations. So this is what I call PO, not a purchase order, but this is in short form, we call it as performance obligations. Now, when you look at a contract with a customer, there are a couple of promises. Please hear the word very carefully, because this is one of the tricky steps in terms of the standard. And trust me, even in a practical life, sometimes this step can be very challenging indeed. We'll dig this step very deep, not today, but I guess in the tomorrow's class. But just to give you a flavor, when you look at a contract with a customer, it contains a lot of promises. It contains a lot of promises in the contract. Now, one thing you need to remember that when I use the word promises is not a performance obligation. Don't use these two terms interchangeably. Many people do a mistake that they say that if a contract is got, let's say, 3 promises, then they say that every promise is a performance obligation. No. I can only tell you one thing, that what we're going to do in step number 2, I'm going to make a list of promises. and then evaluate, is each promise a performance obligation or not? Mind the words. In step number 2, what I'm going to do, I'm going to make a list of promises with me and I will identify, is each promise a performance obligation or not? There are certain parameters which are given in para number 27. The key para which is given out here is supposed to be para number 27. There is a para number 27 and a para number 29, which will help me in identifying whether a given promise is a performance obligation or not. So we'll dig deep into the inputs in para number 27 and 29, which elaborates me whether a promise is a performance obligation or not. So it is quite possible. For example, that let's say in a contract, there are 3 promises, but they turn out to be a single performance obligation. You pick up a contract and you see that there are 3 promises in a contract, but I would say after applying the para number 27 and 29, that all 3 promises are supposed to be one single performance obligation. Or there is a possibility that these are treated as 3 separate performance obligations. Every promise becomes a performance obligation. Or there is also a possibility of grouping, which means that 2 promises are clubbed as one performance obligation and the other promise becomes a performance obligation. So 3 promises could become a case of 2 performance obligation. 3 promises could become 3 performance obligation, or 3 promises may become only a single performance obligation. So remember, the word promise and performance obligations are different. We need to evaluate in step number 2 that is the promise also a performance obligation or not. That's it. We'll see the details later. Then we come to the step number 3, and the step number 3 is identify what we call TP. So identify what is the transaction price. So identify what is a transaction price. We call it as TP, not transfer price, but this is called TP, transaction price. In simple words, what is a TP? The transaction price is basically a consideration which the customer will pay to the reporting entity. Now, there could be a lot of challenges in terms of calculating the transaction price in a contract. The challenges could be in terms of that the consideration may not always be fixed. The consideration might include a variable component as well. The challenges could also be that the consideration may not always be in a cash. There could be a non-cash consideration as well. There is also a possibility that there might be an advance given by the customer, or there might be a deferred consideration by the customer. So there could be a possibility of an interest element in the transaction price as well. So there are a couple of issues which are addressed in step number 3, that when you look at a transaction price, there could be an element of interest. There could be an element of a variable consideration. There could be an element of a non-cash considerations, etc. So we're going to dig deep into the concept of identifying the consideration, which is called the transaction price. Then we go to step number 4. So this is the chronological order in which the standard is being laid down. You need to identify that it's a valid contract. You need to identify the performance obligations. You need to identify the transaction price. Then step number 4 is based on step 2 and step 3. We need to allocate the transaction price to various performance obligations. We need to allocate the transaction price which we computed in step number 3, and this is to be divided. This is to be allocated to the various performance obligations identified in step number 2. Because in this particular case, the revenue recognition will take place as and when each obligation is met. So it is necessary that this transaction price, which is a consolidated consideration, is allocated to the various performance obligations. So this is going to be a mathematical exercise of allocating the transaction price to the various performance obligation. So based on step number 2 and 3, my step number 4 would apply. We'll take a very simple example to give you a run through after the steps. And then finally, there is a step number 5, and the step number 5 is revenue recognition. The step number 5 is revenue recognition. It is the timing factor for the recognition of revenue. And the standard is very clear. And here I would like to give you one insight. The revenue recognition could be based on what we call a percentage of completion method, or it can be based on a completed contract method, a POCM, percentage of completion method, or you can call it simply as PCM. Or CCM, that is called a completed contract method. So there is a possibility that revenue recognition will take place as the work is still going on. I don't need to wait till the entire work is done. We can calculate the revenue based on as and when the work is still carried on. Or it could be based on a completed contract method. There is a lot of confusion. People believe that as far as the Ind AS 115 revenue standard is concerned, revenue recognition is based on only a completed contract method. No, depending upon the circumstances. And this entire insight is given in terms of para number 35. Now you would say, sir, you gave us the para 9 for step 1. You gave us para number 27 and 29 for step 2. You didn't give any para numbers for step 3 and 4. Well, we'll come to those interesting paras later, because there's not one, but a little more paras on that. So, but the crucial paras, trust me, if you need to get a good grip on the standard, in terms of step number 1, you need to be clear on para 9. If you need to get a good grip on step number 2, you need to be clear on para number 27 and 29, though you don't need to remember the para numbers. And if you need to get a good grip on the step number 5, the para number 35 tells me which cases do we apply a POCM and which cases do we apply a CCM. That means, do we recognize revenue as and when the work is still being carried out, or do we wait for the revenue recognition once the entire work is done? So completed contract or a percentage of completion method. That was just a very quick view in terms of the 5-step model which is being laid down in this particular study. I know you must be thinking, so can we have a very basic example where we could have a little run through of the 5-step model before we start digging into each and every step in detail? Why not? Let's take a very basic example at this stage, so that at least we get a little overview of the application of the 5-step model. Let's take a simple example. Let's say there is a company ABC Limited, which is a reporting entity. And let's say there is a customer XYZ Limited. So there is a company which is a reporting entity, and there is a customer XYZ Limited. Now this company, let's say, sold a laptop. Let's say this company sold a laptop to the customer and they also gave a 3 years AMC, annual maintenance contract. So there is a company ABC Limited which sold a laptop with a 3 years AMC to the customer. Let's, I think, begin and let's consider that okay, I'll give you the details later. Let's now apply the 5-step model in this case. Let me just make a walkthrough on the 5-step model in this case. I would first of all identify that is it a valid contract? Let's presume that all the 5 essential elements, which we don't know as of now, let's assume that all the essential 5 elements are present. So let's say, yes, it is a valid contract. Then I go to the step number 2 and I identify the performance obligation. I don't think so. I need to really ask you that what are the performance obligations visible in this example? Can I say there are 2 promises, and it seems to me on a logical front that these promises, each one of them is a performance obligation. I am going to give a laptop to the customer, that is one obligation. I'm going to give him a 3 years AMC, that's another obligation. So I would say that there are 2 performance obligations. One is, you can say, the laptop which is given to the customer, and one is the 3 years AMC. They become the 2 performance obligations. Then I go to the step number 3. And when I go to the step number 3, I said, okay, what is the contract price? Let's consider there has been a fixed consideration. So let's say company ABC told XYZ, we are going to take a consolidated consideration, let's say 1,20,000 rupees as a total fixed consideration for the laptop and the AMC put together. That's a combined, a consolidated consideration. Okay, we go to the step number 4. Let us allocate the transaction price to the 2 performance obligations, that is a laptop as well as the 3 years AMC. Let me allocate the consideration. So now the question rises, how would you allocate this consideration between the 2 performance obligations? Simple. I am going to put across a question to myself, and the standard says put across a question. If the company ABC would have sold a laptop without AMC, what would have been the prices? If the company ABC would have sold an AMC without a laptop, what would have been the prices? Right now, what you're doing, you are selling a bundle of goods and services. Mind the words. Right now, what you're doing, you're selling a bundle of goods and services. You are selling a laptop along with the AMC. It's a bundle of goods and service. We are trying to unbundle them. Basically, what we're trying to do, we're trying to unbundle them, and we're trying to say that if you would have sold just a laptop, what would have been the price? Let's say the company would have said that if I would have sold a laptop, I would have sold it, let's say, at 90,000. And if I would have provided an AMC separately, let's say I would have provided at 30,000. I know what you're thinking. You would say, sir, 90,000 laptop and 30,000 AMC becomes 1,20,000. You did not give any discount to the customer. I intentionally didn't want to take any complications at this stage. I know that if you would give a bundle of goods and services, there is a possibility of discount. But we'll discuss the concept of discount later. So to keep it simple, what I've done, the breakup, if only a laptop was sold, it would have been sold at 90. If only AMC would have been sold, it would have been sold at 30. So do one thing, divide this transaction price 1,20,000 in the ratio of 90:30. Divide it in the ratio of the relative standalone prices. So we can say allocation of this 1,20,000 is 90 and 30. This is the allocation of the transaction price to the various performance obligations in step number 2. And finally, we come to the step number 5. I need to understand how do I recognize my revenue. So the question arises, for a laptop and for the EMC, what kind of method do we apply for revenue recognition? I think it makes common sense that as far as a laptop is concerned, you would have handed over the control of that laptop at time 0 to the customer. When the customer came to you, you would have given the laptop there and then, and you would have said it's yours. The legal ownership, the control, the risk and reward, everything gets transferred to the customer. So I think it makes sense that we can recognize the revenue of 90,000, can I say, immediately on sale. We can recognize this 90,000 immediately on sale, because once the laptop is transferred to the customer, the control of the goods is being transferred to the customer, I can recognize my revenue. And if I consider how do I recognize the revenue of the 30,000 rupees, I would say it should be spread over a period of 3 years, because as and when this obligation will be discharged, it would make logical sense to perhaps recognize this revenue on a straight line method for a period of 3 years. So indirectly, we can say that here you are following what we can say indirectly a percentage of completion method, because you're saying as and when the work will be done. I'm not going to wait for the entire 3 years to get over. It's not a completed contract method. It's a percentage completion that, let's say, 1 year is done, or let's say even on a monthly basis, let me start recognizing revenue as and when the work is being done. So this is a simple example to give you an exposure of how the 5-step model is going to be run in this particular case. I hope I am pretty much clear on the application. Trust me, friends, if you ask me, in the last almost like 45-50 minutes, we've done nothing, but we've just given you a very basic exposure to kick off the standard. I think let me just quickly consolidate the inputs which I've given you, because right now it's the first class of this particular standard. But as we go to progress further, complications would increase. But today you're not going to find any complications. But let me tell you one thing, that this standard requires a lot of understanding of certain concepts. And I think you would have already got a flavor that, when you were doing accounting at the intermediate level, it was, quite a practical kind of questions that you start making journal entries, you start making ledger accounts. Financial reporting in CA Final has taken a lot of change, right? You would have realized suddenly that, this has become quite a theoretical subject as well. A lot of people ask me at times that financial reporting has got a lot of theoretical concepts. Well, they're not theoretical concepts, they are practical concepts. But it's become more like a subject like taxation, like indirect and indirect taxes. You do first a lot of study on the provisions, and then you apply those provisions to practical illustrations. Financial reporting, trust me, has become a similar kind of subject where you need to get a little insight, a good insight, I would say, in terms of the provisions of the standard. The Indian accounting standard is the base on the basis of which the financial reporting is being done. So you need to be very conceptually clear on the application of the standard. So you need to first of all understand the concept and then apply it to the case study. The traditional kind of accounting, where you're looking at journal entries, ledgers, and all those things is taking a little backseat. So we need to change a little mindset in terms of, appreciating the standard as well. I hope you believe, you've understood what I'm up to. Okay. So let's take the journey forward. Let me do a little consolidation before we formally now begin with this standard. So what I've given you so far is very simple. Just keep your register in front of you. Just give me a 2 minutes patient listening, and then we take the journey forward. I've first of all given you that this standard is got 3 important terms. Immediately what should flash in your mind is the word revenue. And when the word revenue flashes to your mind, you should immediately think of the word revenue versus income, and income is a wider term. Per se, the standard applies to the recognition of the timing factor of revenue, but it also applies to the timing factor of other income as well. Contract is understood in a normal sense. The reporting entity and the customer has got an oral, written, or customary business practice. Then you're looking at the customer. Who pays the consideration, who consumes the final output of the entity is the customer. Then I give you a 5-step model in terms of the standard, and I think it's easy to remember. You need to see that it's a valid contract. Validity not from the legal perspective, but validity from the accounting perspective. The focus is some 5 essential elements list is there. Step number 2 is getting the performance obligations, and we've understood promises and performance obligations are 2 different terms. In other words, we need to identify that is the given promise a performance obligation. Every promise may not be a performance obligation. Step number 3 is getting the transaction price, the consideration the customer pays to the entity. Step number 4 is allocating the transaction price to the various performance obligations. And step number 5 is the timing factor for recognition of revenue. Do we recognize a revenue on a percentage of completion method, or do we take a revenue on the basis of completed contract method? Great. Well, I guess so far so good. Let me see if there are any questions coming to your mind so far. Okay, Namrata said, so we have to first focus on the provisions, right? Absolutely correct. Okay, so I think so far so good. Let me now start the journey, friends, with you. I'm going to now take you to the step number 1. So that means I'm looking at the valid contract, and there are some more nitty-gritties which I need to explain. So hear me very, very carefully. We'll do case studies after the concept is done. I'm going to take you to step number 1, and I'm going to break it into a 3-step model. Now, this is my 3-step model. The step number 1 is what we're going to concentrate on. We're going to concentrate on step 1, and I'm going to bifurcate the step number 1 into a simple 3-step model. Let's begin the journey. I'm going to first of all take you to the study material, and in the study material, we are given some insights. And okay, I think there is something more interesting awaiting you. I don't know whether I should discuss this at the inception or not. I think we should. Okay, before we begin with the 5-step model, let's give you something more. And this is regarding the scope of the standard. I am not going to explain you the entire scope of the standard, but I'm just going to explain you one aspect of the scope, which is discussed in the study material as well. So I think let's do one thing. Let me just take you to the study material page 3.3. Have a look, friends, on the study material page 3.3, and I'm just going to read something out here. I guess it's visibly clear. We zoom it slightly more. Yes, I think this should sound good. So let me just read something very interesting to you in terms of the scope of the standard. I'm not discussing the entire scope of the standard. I'm just discussing one portion of the scope before we go to step number 1. Now it says in the scope of the standard, entity shall apply this standard to all contracts with customer except the following. This is the study material page number 3.3. Just open the page 3.3 of the study material. It says very clearly, an entity shall apply this standard to all contracts with customer except the following. I am only looking at the clause number D. I'm just looking at the clause number D. My focus is just on the clause number D, friends, nothing else. I'm not looking at the entire scope from the examination point of view. My focus is just on the clause number D. Let me just read. It says non-monetary exchanges. You know what is a non-monetary exchange? It's a barter system. When I say a non-monetary exchange, it means that it is a barter system. It says, what does it say? That this standard does not apply to a barter system. So if a company does an exchange of goods and services, per se, it is not applicable. So a non-monetary exchange between entities in the same line of business, there is a condition, and the condition is it is not applicable if there is a non-monetary exchange, if the entities are in the same line of business, to facilitate the sales, to the customers or the potential customers. You know, my mind starts working on various kinds of permutation combination. Now, there are 2 important elements which are given in the scope of the standard. It says that this non-monetary exchange is between entities in the same line of business, focus 1. And the objective of this exchange is to facilitate sale. So let me put it like this. There are 2 conditions. If they are met, then Ind AS 115 would not apply. Please hear the words very carefully. There are 2 conditions on a non-monetary exchange. If the 2 conditions are met, then Ind AS 115 is not applicable. So if any one condition fails, Ind AS 115 would apply. So what is the condition number 1? That it is an exchange between entities in the same line of business. What is the condition number 2? The objective of this exchange is to facilitate sale. That means, in simple words, there should be no commercial substance. So I can say There is a condition number one that the entities are in the same line of business, one plus. There is a condition number two, there is no commercial substance. Don't worry, I'll give you the notes later. I'll give you the notes later. We're just trying to focus on the language of the standard. So it says the standard is not applicable in a non-monetary exchange if the exchange is between number one, entities in the same line of business, and number two, there is no commercial substance. You are just trying to help each other. There is no commercial substance. There is no commercial objective in the deal. You're just trying to help each other. So if the two conditions are met, then in that particular case, Ind AS 115 not applicable. So let me ask you a few questions. Before that, let's read an example as well. For example, this standard would not apply to a contract between two oil companies. Two oil companies means they're in the same business that agree to exchange oil to fulfill demand from their customers in different specified locations on a timely basis. The idea is to facilitate the same. The two entities enter into the contract and he says, you help me in the time of need, I help you in the time of need. There is no commercial objective. Now you would say, sir, how do you identify that there is a commercial substance in the transaction? No worries, we will see that later. But before that, let me ask a few questions to you, friends. Let's see, how do you answer them? Question number one. Okay, I think we've got some question as well. Shriram, you said, so in case of completed contract method, value AMC 30,000 is entirely recognized in year three? Yes. In case you reach a conclusion that a CCM should apply, then no part of 30,000 can be recognized until the end of the third year. But of course, in case of AMC, that would not be the case. But theoretically, if you're applying a CCM, yes, revenue recognition will not take place until the end of the third year. Okay, number three, your question, identify contract identifies the performance obligations, compute the transaction. Okay, you said the 5 steps. Okay, that's it. Okay. Now, my question, friends, quickly answer these questions to me. We've seen Ind AS 115 would not apply if it is a barter system when the two conditions are met. I'm going to give you 3 inputs. You need to tell me Ind AS 115 is applicable or not. Number one, it is an exchange between entities in different line of business. It is an exchange between entities in different line of business. Would 115 apply? Remember, unless you meet the two conditions, Ind AS 115 would not apply only if you meet the two conditions. So there are two entities which are exchanging goods and they are in different line of business. So would it apply? Wonderfully said. Yes, that's right. Absolutely. It will apply. Number two, the entities are in the same line of business, but there is a commercial substance. Would Ind AS 115 apply? They are into the same line of business, but there is a commercial substance. They've got a commercial objective in terms of exchange. They're not trying to help each other. They've got a pure commercial objective in terms of exchange. Would Ind AS 115 apply? Yes, that's wonderful indeed. That's right, Manav. Great. Super. Okay, so we have the third one now, and I think that's pretty clear. Can I say if the exchange is between the same line of business and there is no commercial substance, then that's the only case where it would not apply. Now, my mind is working on a small little chart before I take you to some examples on this permutation combination. So my mind is now working absolutely clear on the agenda. Let me just add a notes. Let's add some notes out here on the scope of the standard so you can note it down. I am looking at the scope of the standard. So we're looking at the scope of the standard in terms of which cases would it apply and which cases it's not going to apply. So you can say that we're looking at a non-monetary exchange. We're looking at a non-monetary exchange, barter system. So I think let me do one thing. Let me put it in the brackets that it is a barter deal. So there is a non-monetary exchange. So the standard has made it very clear that if there is a barter deal as well, then it can be within the scope of the standard. So there is a barter deal. We can say there are two permutation combinations. It is between It is between entities. It is between entities in same line of business. It is between entities in same line of business. That's one combination. Or it is between entities which are in different line of business. Let me underline word different line of businesses. So either they are in the same line or they are in different line of businesses. If they are in a different line of business, I am not going to see any commercial substance. The moment they are into different line of business, a commercial substance is implied. So in this particular case, outrightly we can say that Ind AS 115 is applicable. So the moment they are into different line of business, undoubtedly Ind AS 115 is applicable. So the question arises, what is the amount of revenue which the company is going to recognize? Because if you say yes, the standard is applicable, the next question arises, what is the revenue to be taken? So I think let me just add one more input, though we'll cover this in a practical illustration with you as well. So revenue in this case is equal to fair value of the consideration received. Is the fair value of the consideration received. And I'll give you an example. Quite recently I heard that there was a tie-up between two companies. I don't know whether it is exactly happened or not, but I think I read it in the newspaper, that there was a barter system deal between the two companies, BSNL and Patanjali. So what they decided was that, BSNL is going to give talk time to the employees of Patanjali. And Patanjali is going to give, products to the employees of BSNL. I don't know, I just read it somewhere, but just let's take it as an example. So there was a barter deal between the two companies that first of all, BSNL is going to give a talk time to the employees of Patanjali. And Patanjali is going to, give the customers of BSNL the products of Patanjali. So the question rises, is BSNL and Patanjali into a same line of business or are they into a different line of business? Undoubtedly, they're into different line of business. So if they are into a different line of business, would Ind AS 115 apply? So would BSNL recognize revenue? Yes. Would Patanjali recognize revenue? Yes. So what is the amount of revenue they're going to recognize in this case? The amount of revenue is the fair value of the consideration received. What does Patanjali get? It gets a talk time. It gets a talk time. So we will take the fair value of the talk time. That becomes a revenue for Patanjali. What does BSNL get? It gets the products of Patanjali. So whatever is the fair value of the goods they receive from Patanjali, that becomes a revenue for BSNL. So what do you receive? Remember, if you've done Ind AS 16, when you look at a property, plant, equipment which is acquired by way of a kind consideration, exchange of goods, we always say that the cost of the item is the book value of what you gave. When you consider the cost of acquisition, you always say that we need to consider the book value of what you gave. But in terms of revenue, the amount of revenue is not what you gave. The amount of revenue is what you receive. So please go with a very clear-cut distinction that in terms of 115, you need to consider the fair value of what you're going to receive. But when it comes to the cost of acquisition for a PPE, you got to consider the book value of what you gave. So therefore, a very clearly written fair value of the consideration received. So what the company is going to receive in kind, you need to consider the fair value of that amount. That becomes revenue for the concern. Okay. Now, if they are into a same line of business, then I need to further decide another thing. That I need to decide, is there a commercial substance? We'll see how do we evaluate a commercial substance. But you need to see that is there a commercial substance or not. So is there a commercial substance? Is the objective commercial in nature? So if the answer is yes, there is a commercial substance, then Ind AS 115 is applicable and revenue recognition would take place. But if you say no, there is no commercial substance, then we can say Ind AS 115 is not applicable. So this is a clarification chart with reference to the scope of the standard. So wherein we are trying to look at that if there is a barter deal between the two entities, you need to first of all decide, is it between the entities in the same or different line of business? If it is in a different line of business, no further questions asked. You need to directly apply 115. But if they are in the same line of business, you need to see that there is a commercial substance or not. We will look into the facts of the question to decide whether there is a commercial substance or not. If you say yes, there is a commercial substance, 115 applicable revenue recognition would take place. If you say no commercial substance, then in that particular case, Ind AS 115 is not applicable. No revenue recognitions is going to take place, right? Okay, so I guess I am pretty clear so far at this stage. Okay, I think Shriram has got a question. So in case of a non-monetary exchange, that is a barter system, is revenue recognized by measuring the value of the products or services supplied in money or money's worth? Well, we need to consider the fair value, that if they would have been sold in cash, then what would have been the fair value of these items? So basically, as we said, that Patanjali would receive, let's say, a talk time. So I need to consider that what is the fair value of the talk time. If BSNL would have sold that talk time on a cash basis to other companies, what is the fair value? But remember, when you consider a fair value, the reference to the fair value takes you where? It takes you to Ind AS 113, right? So the calculation of fair value will be done on the guidance of Ind AS 113, but we need to consider that, okay, whatever you're receiving, let me get the fair value of what you receive, and that becomes a revenue for the receipt, right? I guess pretty clear on that. Okay, so I think let's begin with the case studies, friends, with you now. On this area, I have just added a few questions, and let me just take you to the questions now. Just give me a second. I guess I put some questions in the end. Right, so I think this is the question number 3. Let me just take you to the question number 3 at this stage. Let me just take it a little above. So we're looking at the question number 3, which is on the scope of the standard. Let me just read this question, and we're going to decide same line, different line, commercial substance, all those parameters, and we'll evaluate things. Let me read the question to you. It says A and B both are engaged in manufacturing of homogeneous bottle. I don't think so. You know what I've done? I've already given a red color to the important words in the question, because one of the things which I feel is very important is that when you read a question, there are certain words in the question, which indicates the answer as well. It's like Basanti, tumhara naam kya hai? And still people say Basanta. Okay. So A and B both are engaged in manufacturing homogeneous bottles. So one thing is very clear, that they are into the same line of business. But we need to see whether there is a commercial substance or not. A operates in northern, eastern, and central part of India, and B operates in western and southern part of India. So they are operating in different parts of the country. A fulfills the demands of the customer based on western and southern India by using the bottles manufactured by B. Now, since A is operating in northern, eastern, and central part of India, so whenever he gets a demand from the western and southern part of India, he goes to B and says, please help me. Similarly, B fulfills the demand of the customer based on northern, eastern, central part of India by delivering the bottles manufactured by A. So they are fulfilling the demand of their customers. So when A gets a demand in a region where B can supply, he requests B, please do the needful. When B gets a demand from an area where A is present, he goes to A and says, please help me. They are trying to help each other. I don't smell any commercial substance at this particular stage. Let's, I think, read further. Because I think if there is a commercial substance, it would be very, very clearly stated in the question. The things will be very, very clear, I guess. So the question now in this particular case is, it says how A and B should recognize a revenue. So this is a question from the education material. I guess after looking at the facts of the case, one thing is very clear, that they are into same line of business, one. And I don't see that there is any commercial substance because A is trying to fulfill the demand by taking the help of B. B is trying to fulfill the demand by taking the help of A. I think it seems to be a pure case of help. So therefore, commercial substance doesn't seem to be the case. So in this case, the exchange qualifies to be a non-monetary exchange. They are into same line of business. Accordingly, A and B should not recognize any revenue, and therefore Ind AS 115 is not applicable. I think it's a pure case number one, same line of business with no commercial substance. Let's look at another question. Okay, let's have a look at the question number 4. It says entity A and B are both engaged in extraction and supply of natural gas. I think that word itself is indicated that they are into the same line of business. Both are engaged in the extraction and supply of natural gas to different parts of India. Now look at the language further. A is located in Western India and B is located in southern part of India. So they are located in different parts of the country. A contracts to supply natural gas to large corporate customer XL located in southeastern region of India, who is engaged in supply of natural gas to homes. B, on the other hand, contracts to supply a natural gas to YS, which is located closer to A. Consequently, A purchases from B to supply the gas to YS, and B purchases from A to supply the gas to XXL. Now, see the red words which are indicated. The price of the gas for this transaction will be based on the actual delivery date by either party. The parties will do a monthly calculation of supplies and receipts of gas and do a net settlement based on the prices calculated above. Whenever I look at this particular sentence, it comes to me. There is a dialogue which comes to my mind is मुझ पर एक एहसान करना कि मुझ पर कोई एहसान मत करना. Sorry, but it reminds me of a very popular dialogue, which says मुझ पर एक एहसान करना कि मुझ पर कोई एहसान मत करना. What do you think with these inputs which are given that the price of the gas is based on the actual delivery date? So he says, boss, I will help you. But remember one thing, that I'm going to charge you the price based on the delivery date. Boss, I'm going to help you, but we're going to sit down on a monthly basis and we're going to do a net settlement of all the deals we have done. Nothing comes for free in life. There are no free lunches in life. Do you think this smells the concept of a commercial substance which is present? I would say, of course, yes. If you are telling the person that I am going to do a net settlement based on the prices on the actual delivery date, you are not trying to help each other. You've got a pure commercial objective in mind. If you've got a pure commercial objective in mind, how can I give you an exemption in terms of recording revenue in the books of accounts? In the said industry, the price varies on different products and also varies at the point of sale. How do you treat this situation under Ind AS 115? I think it's undoubtedly a case where both the companies A and B are going to apply Ind AS 115, though they are in the same line of business, but there is a commercial substance. A would recognize a revenue based on what he gets from B, the fair value of what he gets from B. And B is going to recognize a revenue on the basis of what he gets from A. Makes sense. So I think we've done two questions. One question is same line of business with no commercial substance. Another one which is a same line of business with a commercial substance. I think now the third question you can predict, they are going to be in a different line of business where Ind AS 115 is going to apply directly. Let's have a look at another question with you. Let's go to the question number 5. So let's have a look at question number 5. This is again in the education material, and I think one of these questions is there in the study material as well. It says a telecommunication company. So A is a telecommunication company entered into an agreement with B, which is engaged in the generation and supply of power. So one is a telecommunication company and one is a power company. So they are definitely into different line of business. Am I supposed to look into the presence of commercial substance? Of course not. The concept of commercial substance would apply only if they are into same line of business. The moment they are into a different line of business, I am going to apply Ind AS 115 outright. The agreement provided that A will provide 1 lakh minutes of talk time to the employees of B in exchange of getting a power equal to 20,000 units. So they're going to get 1 lakh minutes of talk time, and in exchange, there is a power of 20,000 units. The talk time is 50 paisa a minute, and the power is 2.5 a unit. Now, there is something very interesting to watch. And I think this could trigger a lot of questions in your mind, but I think we're not going to get into the PhD of all these things. But you can see one thing. 1 lakh minutes of talk time is worth 50 paisa a minute. That works out at 50,000. 20,000 units of power at the rate of 2.5 a unit also comes to 50,000. It's a fair deal. It's a fair deal. Now you would start asking me, sir, if the value of the talk time is not equal to the value of the power, then what? Trust me, friends, I can tell you one thing. If in all these questions of scope, I ask people to tell me to put journal entries in the books of A and B for the exchange of goods and the revenue recognition. Trust me, this is what is going to happen to people. You can't learn everything at the examination levels. There is a lot more to learn in life. Trust me, if you look at Ind AS 115 from a practical life point of view, it can be very, very complicated indeed, because the application of the standard requires an understanding industry-wise. If you look at the application of the standard to the telecommunication industry, it has got its own challenges. If you look at the application of this standard, let's say to a power sector company, or let's say to other sectors, like for example, infrastructure, like for example, if you look at, infrastructure is one, telecommunication is another, then there could be challenges of a different kind. So typically the standard to the real estate sector, typically the standard, I would say the telecommunication sector has got its own kind of challenges altogether. So I think we don't want to get into all those details. So the idea is that if these values are same, I would say it's a fair deal. You are giving something, the fair value of what you gave is equal to the fair value of what you receive. So absolutely a fair deal. Well, there could be a possibility of different amounts as well. But I think if different line of businesses are dealing in a non-monetary transaction, a barter system, I think they're always going to deal in a way which is a fair deal to both of them. What you give and what you receive would be of an equal value. I think, therefore, in the education material, they've addressed only this particular example where the fair value of what you receive and the fair value of what you give is equal. They never address the issue that it is going to be an unequal amount, because I think that would not happen generally in a common sense. Okay. So it says, how should revenue be measured in this particular case? Well, Ind AS 115 is undoubtedly going to be applicable. So what is the revenue which the telecommunication company would take? Let me now ask you, is the telecommunication company going to record the fair value of the talk time? Or are they going to record the fair value of the power unit received? Get this very clear. Let's get the answer. So what is the revenue which the telecommunication company is going to record in this particular case? Are they going to record the fair value of the talk time, which they are giving, or are they going to record the fair value of the, you can say, power which they are getting? So what is the revenue? What do you get or what do you pay? Can I say revenue is what you get? So telecommunication company is going to record what? Can I say the fair value of the power unit received? 50,000. What is the other company going to record in this case? The other company is going to record the fair value of the talk time they're going to receive. That's correct. Okay, Sriram, you got a question? So in the example of BSNL and Patanjali, if the fair value of Patanjali products given to BSNL employees without getting returns in the form of any cash is more than BSNL plans benefits to Patanjali, I think you're looking at the same question, that if the fair value of these goods is not of equal amounts, how do you account for it? Now, let me tell you something very interesting indeed. It's good that you're asking that question, but I think I'll have to contain myself considering the time and the examination levels as well. If you look at Ind AS, any Ind AS for that matter, it is comprehensive, but at the same time, there are many issues which are not addressed in the standard. I have a knowledge on US gaps as well because I deal with US gaps as well. And trust me, if you look at US gaps and IFRS, US gap has got a question answer to everything. They've got an answer to everything in life because it's a rule-based standard. So they don't want to leave anything to the judgment of the corporate sector. So they try to address everything. And if you look at the size of US GAAP, if IFRS is running in around 1,000 pages content, trust me, US GAAP is running in around 10,000 pages content. The content in terms of US GAAP is huge in nature. And that's the reason, that there was a time when even US economy wanted to come over to IFRS and switch over to IFRS, but they never did that. It was way back in 2010, they had a deadline that we're also going to apply IFRS, but then they realized, no, we're not going to do that. Of course, they believe themselves to be a superpower as well. But at the same time, considering that they had a rule-based kind of accounting, well, on a very grave difficulty, they came together, and IFRS 15 was a success project in terms of FASB and IASB. But if you look at the story in terms of leases, it was not a very successful kind of a project. Even IFRS 16 on leases, which is Ind AS 116, is a joint project of FASB and IASB. But there are still a lot of principal differences in terms of lease accounting. Then, all the latest projects have been quite a failure. They've not been coming together and to create certain things. Yes, the differences in the US gaps and the IFRS is getting narrowed down over a period of time. But the problem in terms of IFRS, one of the major problems is that it addresses only the overall concept. If you get into different kind of situations, it becomes judgmental. And when it becomes judgmental, all I can say that it cannot come in the exams. I would say that in terms of the application of IFRS, there are a lot of permutation combinations which are not addressed in the standard, and these are judgmental. You need to look into a lot of things, and they would not be touched in exams. So from the examination point of view, I think we're pretty much safe indeed. That's all I can say. Okay. Right. And I think, Lipika, you've got a question. So it's not clear why the telecom company should record a fair value of the power received as revenue. Okay, let me put it like this. If you buy something and if you sell something, let's look at the perspective very clear. I would just like to highlight this point very well because sometimes it could create a confusion in terms of Ind AS 16 and Ind AS 115. Now, imagine if you buy a machine, and you are going to give a particular asset. You buy a machine in exchange and you give a particular asset. What is a cost? Cost is what you pay, right? So cost is what you pay. So what do we consider in terms of exchange when you buy a particular machine? You take the fair value or you take the book value of what you give. The focus is on what you give. So when you're going to look at Ind AS 16, that there is a acquisition by way of exchange. You gave an asset to acquire an asset. We never record the asset per se at a fair value of the asset acquired. If I acquire an asset in exchange for an asset, I will never per se record it at the fair value of the new asset. I will always consider the book value of what I gave. I'll always consider the fair value of what I gave, because what is my cost of acquisition? My cost of acquisition is what I give. So when you buy, the focus is on what you give. But now let's look at from a revenue point of view. Revenue point of view means that the customer is paying me something. So if he is paying me something, revenue is what you receive. So when you sell, the focus is on what you receive. So if you look at from the point of view of the telecommunication company, what is the telecommunication company doing? It is giving the talk time. That's not my revenue. But what it is getting in return is supposed to be the power units. So what you receive is the revenue. So there is a perception in terms of revenue. Revenue is what you receive. So the telecommunication company receives the power units. But when you buy something, what do you give? So remember, there is a difference in perception of when you buy, you consider book value or fair value of what you give. When you record a revenue, you need to consider the fair value of what you receive. I guess I am pretty clear on that. That answers your question, Lipika, I guess. Okay, Janvi, you've got a question. So, in case of unequal amounts, when then we'll recognize the difference in profit and loss account? Well, there is no guidance which is given in Ind AS 115. So, I just intentionally wanted to reflect the fact that the fair value of what you're receiving and the fair value of what you're giving is same. Now, if there is a difference between the two, there is nothing which is addressed in the standard. If you look at the language of the standard in terms of scope, they're only telling you that if they are in the same line of business and they are trying to facilitate sale, then it is being scoped out. They're not even addressing the issue that what is scoped in. It is in the education material that they've done a research and given you the permutation, combinations, and that. Right? Okay. So far, so good. So are we good to go ahead, friends, with you? So are we comfortable so far? Are we absolutely clear with the discussion so far? I've not even started my step number one. I've just given you the introduction to the standard with the 3 terms, the 5-step model, and I've given you the scope of the standard. But are we absolutely comfortable at this stage? Let me get your comfort zones on the understanding so far. So if you want to scale yourself on a scale of 10 on your comfort zone, what do you think would be your comfort zone on a scale of 10? You could say 10, you could say 9, 8, whatever is a comfort zone. What do you think is the comfort zone? In the meantime, let me now come back to the study material. And we're going to now start with the step number 1. So let's make a little introduction to the step number 1. Okay, so let's go to the step number 1, where we will look at the para number 9 application. Let's, I think, read it out here. Right, so this is the input identifying the contract. And I think we got some inputs on that. It is 9 by 10, it's 8. Okay, we didn't get much inputs on that. Why I ask the score as well is just to get the feeling, because we can't physically see you. So I think your comfort zone, gives me an idea, because physically connect, you don't need to take the score. You can easily look into the eyes of the person and make your own assessments. Okay, so I think so far so good. I think we're getting a score almost like 8 so far. Okay. Let's take the journey forward with you, friends, now. And I am going to first of all discuss the step number 1. Now, the focus is on step number 1. Now, there are some nitty-gritties in terms of step number 1. I'll give you all those nitty-gritties step by step. Now, in step number 1, I'm going to build a 3-step model. As I said earlier, that in step number 1, I'm going to build a 3-step model. This 3-step model is not given in the standard. This is my own creation for easier application of step 1. Let's begin with, first of all, the inputs in terms of step 1, identifying the contract. So we're looking at the step number 1, that is identifying the contract. Let's have a read on this. Now, in terms of identifying the contract, let's have a read out here. It says Ind AS 115, this is in the study material. Ind AS 115 requires an entity to account for a contract with a customer that is within the scope of the standard only when all the following conditions are met. Well, the standard is very clear, and as I said, this is the para number 9, what I'm reading technically. So there are a total of 5 conditions. Unless and until all the 5 conditions are met, you cannot go to step 2. You cannot go to step 2. So he's very clear, all the following conditions are met. Let's read the conditions. It says the parties have approved in writing or orally or in accordance with the customary business practices the contract. So what is important is that the contract is approved. Don't worry, I'm going to take you very shortly to a case study, but one of the parameters is that the contract is approved. Both the entity and the customer have approved the contract in writing or orally or according to the customary business practices. That's condition number 1. Let's have a look at the condition number 2. There are a total of 5 conditions which are given out here. So let's have a look at the next condition. It says the entity can identify each party's rights. We can identify each party's right. You should be able to identify the rights of the reporting entity, and you should also be able to identify the rights of the customer. He's very clear. You should be able to identify the rights of the each party. Number 3, the entity can identify the payment terms for the goods and services. We need to be very clear. What is the consideration? When will the consideration be paid? What is the mode of payment? Don't worry, I'll give you the notes later. So we need to be clear on the payment terms. What is the amount of payment? When the payment will be given? What is the mode of payment? The payment terms need to be clear. So what is the condition 1? The contract is approved. What is the condition number 2? Each party's rights can be identified. What is the condition number 3? That the payment terms are clear. What amount, when to be made, what is the mode of payment? Then it says the contract has got a commercial substance. Well, generally, there may not be enough facts to evaluate whether a commercial substance is there or not, but we have reasons to believe that when you are charging a transaction price, we will always believe that there is a commercial substance unless mentioned otherwise. And then it says it is probable. Probable means that there is a 50% plus. I'm not saying 50, I'm saying 50% plus. It is probable that the entity will collect substantially all the consideration to which it is entitled. So the collection should be probable in nature. So as we said earlier, that the 5 elements which are given as a part of a valid contract is not something which is by way of Indian Contract Act. These 5 essential elements are more so, you can say, from the point of view of accounting. I need to see, number 1, that the contract is approved. That is number 1. I need to see that each party's rights can be identified. I need to see that the payment terms are very clear. I need to see that there is a commercial substance, and I need to see that the collection is probable in nature. We are pretty sure with a 50% plus chance that whatever consideration is there, we will collect the same. If these 5 conditions are met, then in that particular case, we can go to step number 2. So what happens if these 5 conditions are not met? You cannot go to step number 2. Then what do? You keep making a reassessment of these 5 steps. You need to continuously make a reassessment of these 5 conditions, because unless and until all these 5 conditions are met, you cannot go to step 2. But there is more in terms of this step number 1. But let's do one thing. Let's first take a very simple example with you before we look into any further nitty-gritties on step number 1. So let's take it further. I have a small little question which I have put across on this particular area. This is again a very simple little case study from the education material, and this is going to give you an insight on evaluation of these 5 parameters. Just a second. Right, so that is the one. Let's have a look at this. So this is the question number 6, which is based on my step number 1. So I'm looking at the question in step number 1. Okay, now let's have a look at the step number 1. Question number 6, I think it should be clearly visible, I guess. Okay, so no worries, I'll give you a break after this particular question is done. No worry. So if you're thinking that we're going to take a break, we are going to take a break, but just give me a little time to just finish this one. I'm going to read the question number 6, and you need to evaluate, are the 5 essential elements which we just read, are they present or not, right? So we just going to read it carefully. We just need to evaluate the 5 elements are present or not. It says X Limited provides IT support services to the customer from a distant location. The customers call up the support team, who understand the client's requirement over the phone and provide necessary advice to the customer to resolve the issue. Before providing advice, I've already made red colors. It says before providing advice, the support team member will understand the client's problem and inform them about the price for the services to be provided. So I think the customer has got a certain right that he will be, first of all, informed about the price which he will be charged. Once the problem is resolved, the customer will make the agreed payment to X through online banking mode. So I think the rights of the entity is very clear that once the problem is resolved, the customer needs to make a payment. So I think I am visualizing that is the rights of both the parties clear. I think yes is probable. That's a third one. And the oral contract is enforceable. That means that it is approved. And in such a case, whether it is a valid contract or not. Now, I think if you carefully evaluate the facts, I gave you that one of the condition is always met unless mentioned otherwise, and that is a commercial substance. So let me put across the questions to myself. Is the contract approved? The oral contract is enforceable, so it is approved. Number two, can you identify the rights of both the parties? Yes, I can identify the rights of the reporting entity and the customer. So number two is done. Is the collection probable? Yes. Is the payment terms identified? Yes. The amount, the mode of payment, when the payment is made, everything is pretty clear in this particular case. And number five, is there a commercial substance? Yes. Do you think I need to ask you that is it a valid contract? Let me still ask you, is it a valid contract? Can I go to the step number two in this particular case? Your insights on that. And I think that's right. He said, yes, it is a valid contract. Okay, Namrata, you said, please can you give examples of identifications of each party right? I think you would have got your answer because in this particular case, we can see that the rights of the party is the customer is got a right that he has to be disclosed the price he will be charged for the service. He's got a right. The entity has got a right that once the problem is resolved, he is going to get a consideration at that point of time. So we are very clear that the reporting entity's rights and the customer rights both are pretty much clear. Right, friends. So I think this is on the step number one, but we are not complete with step number one. I know I'm yet to document the notes back to you, but I think first we're going to take a small little break for 10, 12 minutes. And then I am going to start back with you with some more nitty-gritties related to the step number one, because I'm going to take up one more interesting case study with you, but that is also contains one more element, and then I'll document the notes with you. So I think it's almost around 8:41, 8:42, I guess. So I think we're just going to take a short break, friends, at this stage. Okay, Shriram, you said the video is getting stuck often. Maybe it could be due to your internet issue, friends. So just try to refresh. Maybe it works because I think everything seems to be going good from our end, I guess. So let's join you back, friends, in another 10, 12 minutes. Enjoy your break. I'm going to see you back. Welcome back, friends. So I hope you took a rest as well. So we were talking in terms of step number one before we went to the break. And in terms of step number one, I have already given you the insight on the 5 parameters which we need to meet in terms of saying that it's a valid contract. But there is something more which we need to get in terms of the step number one. So I'm going to take you to some more insights on step number one, because as I said, I'm going to develop a 3-step model with you, and I'm yet to complete my 3-step model on the step number one. So let me take you to some more insights on the step one. So I'm just going to read a few inputs which are given in the standard with reference to the step number one. Yes, this is the case. Let's, I think, read this, and now we'll be in a comfortable position to create the inputs, the 3-step model related to the step number one. Okay, this is an extract of what is given in the standard. Let me zoom it further. So this is the input which is given in the standard. I've just taken some relevant paras for a little more understanding on the step number one. So let me just read a few things to you. Then we're going to create a 3-step model, and then we're going to take you to a case study based on this. It says if a contract with a customer meets the criteria in para number 9 at the contract inception, entity shall not reassess those criteria unless there is an indication of a significant change in the facts and circumstance. I think from an examination perspective, let's keep it simple, that if the conditions of para number 9 is met, there is no reassessment which is done at a later date. There is an exception, especially when there might be a huge credit deterioration of the customer. The customer is unable to pay the money, but let's not get into that exception. So from the examination perspective, you can say that generally, if the conditions in para number 9 is met, no reassessment is done at a later date. Then he says if a contract with a customer does not meet the criteria in para 9, entity shall continue to assess the contract to determine whether the criteria in para number 9 is met or not. So that I already gave you. And I said very clearly that if the conditions in para number 9 is not met, you need to make a continuous reassessment, because you will not be able to go to the step number 2 unless all the conditions are met. So I think that's what I've already given you. Now my focus is more on the para number 15 and 16. When a contract with a customer does not meet the criteria in para number 9 and an entity receives a consideration from the customer. So indirectly, what we are trying to come is on the issue, a customer gives you an advance. So we're looking at the fact that you are in step number 1 and the customer is giving you an advance. What is the treatment of that advance? Can we consider that advance to be revenue? Or do we consider the advance to be a liability? So para number 15 is addressing the issue that if the conditions of para number 9 is not met and you've received an advance from the customer, mind the words carefully, the entity shall recognize the consideration received as a revenue only when either of the following conditions events are met. You will be able to treat this advance as a revenue when you meet either of the 2 conditions. Now, there are 2 clauses given in para number 15. Either you meet the first clause or you meet the second clause, and then you can treat this advance as a revenue. Now, very carefully count the conditions in clause A and in terms of clause B. The entity has no remaining obligations, number 1. And then it says, and all or substantially all of the consideration promised has been received, that is 2. And then it says, and the consideration is non-refundable, that is 3. Very carefully, you need to look into 3 aspects. If the customer is giving you an advance, you can treat the advance as a revenue provided 3 conditions are met. mind the words very carefully. I know this is getting a little technical, but mind the words very carefully. So if the customer is giving you an advance consideration, you can treat this advance as a revenue, provided three conditions are met. Condition number one, the entity has got no remaining obligations towards the customer. Condition number two, the entity has received entire or almost the entire consideration from the customer. And number three, the consideration is non-refundable in nature. So as an entity, I have no remaining obligations. As an entity, I have received all or substantially all the consideration. And number three, as an entity, I'm not liable to refund it back to the customer. Then the advance can be treated as a revenue, even though the conditions in the step number one is not met. And then it says, or the contract is being terminated, one, and the consideration received is non-refundable, that is true. Now, para number 15 gives you two set of conditions, and you need to meet any two set of conditions. You need to meet any one of the two set of conditions. Either you are able to meet the three conditions in clause A, or you are able to meet the two conditions of clause B, then you can recognize this as a revenue. I'm putting it very clear. So let me now create my three-step model in step number one. What is my agenda in the mind? I am looking at the step number one, that is, it's a valid contract, and I'm looking at step number 1A, step number 1B, and step number 1C. So I'm looking at now the sub-steps in step number one. So what are you going to do in terms of step number 1A? You're going to identify that are the 5 conditions valid conditions present or not. If you say yes, they are present, you go to the main step number 2. If the 5 essential elements of a valid contract are present, I would go to the main step number 2, that is identify the performance obligation. If you say that the 5 conditions are not met, you need to go to the step number 1B. If the 5 conditions are not met, you need to go to the step number 1B. And in terms of step number 1B, you want to put across a question, did we receive an advance from the customer or not? So the answer could be a yes, or the answer could be a no. Don't worry, I'll document the notes very soon. So if the conditions of para number 9 is not met, you need to go to the step number B, in which you're going to say, did you receive an advance from the customer? So either we received an advance or we did not receive an advance. If you say we did not receive an advance, you need to reassess the conditions of para number 9. Keep making a reassessment of the conditions, which are the 5 conditions of para number 9. If you say, yes, the advance has been received, you go to the step number C, and you need to see that either you meet the 3 conditions of para number 15, or you meet the 2 conditions of para 15. If you received an advance, you go to the step number C, and you see that either you met the 3 conditions in the para 15, or you met the 2 conditions in para 15. What are the 3 conditions in para 15? The entity has got no remaining obligations. The entity is received substantially or all the consideration, and the consideration is non-refundable. You meet either all these 3, or you meet the 2 conditions. What are the 2 conditions? The contract is being terminated and the consideration is non-refundable. So either you meet all 3 or you meet any of the 2. The conditions are met. If yes, you can treat the advance as a revenue. If you say no, then in that particular case, what do you do? The para number 16 defines what you do in this case. Entity shall recognize the consideration received from the customer as a liability until one of the events in para 15 is met, or the conditions in para number 9 are met. So you need to watch and wait that either you meet the conditions of para 9 or you meet the conditions of para number 15. So we got a little confused now. Too much data to remember. Well, Ind AS 115 has got a lot of things which you need to remember. Let me tell you in advance, there are a lot of things which you'll have to remember, but I'll make it easy for you by giving you a step-by-step approach. But remembering those steps is, of course, your task. Let me, I think, start the journey with the 3-step model in step number 1, and then I'll document the notes to you. We'll do a case study as well. So the entire inputs in terms of step number one, looking at all the technicalities, is you got to follow a three-step model. In step number 1A, you need to put across a simple question. Are the 5 conditions of a valid contract present? If you say yes, you're ready to go to the step number 2. That is the main step number 2, where you go to identify the performance obligations center. If you say a no, you need to go to the step number 1B. And in terms of step number 1B, you need to ask yourself a question. Did you receive an advance from the customer? The focus will then become on advance. The moment you fail the conditions of para number 9, your focus comes on step number 1B, that did you receive an advance or not? If you did not receive an advance, life is simple. You got to make a reassessment of the conditions of para 9. Keep making a reassessment, because until those conditions are met, you will not be able to go to step number 2. Now, if you receive an advance, you go to step 1C. So step number B is only focusing on advance. That did you receive an advance or not? If you receive an advance, you go to the step number C. Now the step number C is a little crucial. If you receive an advance, you've got 2 set of conditions in para 15. Don't remember the para number. There are 2 set of conditions which are given in para 15. Either you meet 3 conditions of para 15 or you meet 2 conditions of para 15. Now, what are the 3 conditions? The contract, no remaining obligations of the entity, consideration substantially or entirely received, and it is non-refundable. Prove me these 3, or prove me the 2 conditions, the contract is terminated, and prove me that the consideration is non-refundable. If you can prove the 3, or if you can prove the 2, 3 or 2, anything you prove it to me, the advance will be treated as a revenue. And if you fail these conditions, you don't fulfill 3 or you don't fulfill 2, then you've got 2 things to do. Either keep making a reassessment of the para number 9, 5 conditions, or keep making a reassessment when the 3 or the 2 conditions are met. Whatever is met, accordingly, we will go to that. If you meet the conditions of para 9, you go to step 2. If you meet the conditions 3 or 2, then you treat the advance as a revenue. Right? I hope I'm clear with the 3-step model. Don't worry, I'll document the notes. Let me see if there are any questions coming in between. Okay, so are we clear, friends, till this particular stage? I guess. Let me document the notes to you. Let's give you some concrete notes at this stage. So now I'm going to document. I didn't document the 5 conditions to you, so I'm now going to put across a condensed version of the 3-step model which I've drafted at this stage. So let's go to the notes section now, and let's add on the notes to you. So please note down the 3-step model which we are going to document now. Okay, so let's begin the journey. So we've got the main step number. This is the main step 1. And this is identifying the contract. This is identifying the contract. So when I say identifying the contract, it means that is it a valid contract? We're identifying that is it a valid contract, underlying the word valid contract. So that's the issue, that is it a valid contract or not. So we're going to create sub-steps on this. So let's create a sub-steps on this. So we've got sub-steps in terms of the main step number 1, the sub-step number 1. And the first is, are the 5 conditions, underlying 5 conditions of para 9, are the 5 conditions of para 9 met? So we will put across a question, are the 5 conditions of para number 9 met? I think we'll make a list of these 5 conditions also at this stage. So let me just give you in short, what are those 5 conditions? Number 1, the contract is approved. The first is that the contract is approved. Second is each party's rights. Each party's rights can be identified. Underline the word each, underline the word approved. each party's rights can be identified. And then we've got number 3, payment terms can be identified. Payment terms can be identified. So when I say the payment terms can be identified, I think in the brackets, let's make mention how much. So we should know what is the amount, how much, when, and by which mode. So when the payments are to be made and by which mode of payments it is to be made. So the payment terms are clear. Underline the word payment terms. Number 4, there is a commercial substance. There is a commercial substance. And as I said, underline the word commercial substance. Unless mentioned otherwise, we'll always believe that there is a commercial substance. And let's put down the condition number 5 as well. Collection is probable. The collection is probable. And when I use the word probable, underline the word probable in the brackets, you can write down 50% plus. There is more than a 50% chance of collecting this money. Okay, so this is on the sub-step number 1. Are the 5 conditions of para number 9 met? So the answer is either a yes or the answer is a no. So are the conditions met or not? So if you say no, the conditions are not met, then we need to go to step number 2. Then we need to go to the step number, rather 1B. We go to the step number 1B, and if the answer is yes, we go to main step 2. We go to the main step number 2. So in this particular case, we go to the main step number 2, performance obligation. Then we go to the sub-step number 2. So this is like, let's make it ABC. So let's make it 1A. This is 1B. So this is 1B. Then in terms of step number B, did we receive any advance consideration? Did we receive any advance consideration? Underline the word advance consideration. So did we receive any advance consideration? Step number 1C. Then we go to the step number 1C. Okay, I think if you've taken a note, let's take it here. So this is a summary of all the insights which I've given you on the main step number 1. So go carefully on a step-by-step approach, and trust me, you'll never ever go wrong. Right, I guess you've taken a note on this. Let's go to the step number 1C. Then in step number 1C, evaluate is the does the entity meet any one, underline the word any one set of conditions? Does the entity meet any one set of conditions? So we take set number 1 and we'll take set number 2. You need to meet any one of the 2 set of conditions. So we need to identify, does the entity meet any one of the 2 set of conditions? And in this case, we have got number 1, number 2, and number 3. So you need to meet all 3. So we need to meet all 3 in this case. And in this case, we've got 2. We need to meet all 2. So we need to meet all 2 conditions in this case. So what are the 3 conditions? Number 1, entity has no remaining obligations. Entity has got no remaining obligations. That is 1. So entity has got no remaining obligations. That's 1. Number 2, entity has received all or substantially all consideration. it has received all or substantially all consideration. So we have received the full amount or almost the full amount of consideration, and the consideration is number 3. Consideration is non-refundable. The consideration is non-refundable in nature. That is condition number 3. And if you come to the second set of conditions, we can say the contract is terminated. The contract is terminated. And number 2, so let's put it plus. The consideration is non-refundable. The consideration is non-refundable in nature. So you need to meet these 3 or these 2 conditions as the case might be. You need to evaluate the 2 set of conditions. Okay, in this particular case, once you've done the evaluation, so either we say, yes, we met the conditions, or we say, no, we are not meeting these conditions. So if you say, yes, we've met these particular conditions, then in that particular case, we can treat advance as revenue. We can treat the advance as revenue. And in case you don't meet these conditions, we treat the advance as liability. We treat the advance as a liability. Plus, we need to reassess. We need to reassess 5 conditions of para 9. We need to reassess 5 conditions of para 9, or the 3 and 2 conditions of step 1C. So we need to evaluate the 5 conditions of para 9 or 3 or 2 conditions of step C, whichever is met. Whichever is met earlier. So you need to see whichever condition is met earlier, we're going to go with that. Right, friends, so I think that summarizes the entire position and consolidates the entire learning on this particular step. We can do a case study, let you know once you've taken a note on all this. I've written the notes a little faster just to save a little time in terms of writing notes, so you can just quickly note it down and let me know if you're done. Okay, I think Purnima tells me, yes, it's super clear. That's wonderful indeed. Super. Let me know, friends, if you're done. Just give me a message if you're taking a note on this. Then I'll take you to the case study. But effectively, the step number 1 is done. So we'll just quickly consolidate the learnings and then take you to the case study on this. Right, I guess everybody's done with this. We can take it further, right? Okay, so let me just quickly make a run through with you out here. So moral of the story, just hear me well. If you're taking a notes now, just hear me well. Just give me a patient listening and you will be able to consolidate things. I'll give you a mind map towards the end, what we have learned today. But please remember, friends, you need to do a cumulative revision. What we have covered today, please revise. It'll take you barely around 15-20 minutes to do a complete revision of things. And then once we do things tomorrow, please do revision of the first class and the second class, because there are a lot of things which are interconnected, and you'll get a clarity of thought, once the entire standard is done, because it's a bigger standard and it contains a lot of concepts. So you need to continuously revise it as well. Okay, now giving you a quick summary in terms of the step number 1, the main step of this standard. So this is called identifying the contract. In simple words, when I say identifying the contract, it means we are looking at that it is a valid contract. Now, when I say that it is a valid contract, the valid contract is got nothing to do with law. The valid contract is that there are 5 essential elements in a contract present. So what are you going to do in step number 1 is step number 1, A, B, C. The first thing is you evaluate the 5 conditions of para 9. Quickly in your mind, you should get what are the 5 conditions. The contract is approved. Each party's rights can be identified. The payment terms are very clear. The collection is probable, and there is a commercial substance. So if the 5 conditions are met, you're ready to go to the main step number 2. If the five conditions are not met, you need to go to the step number 1B and evaluate whether we've received any advance from the customer or not. So the focus in step number 1B is on the advance. If you've not received an advance, it's a simple case of reassessment of para 9 conditions. But if you receive an advance, then the journey begins and you need to make a good number of evaluations. The moment you say that you've received an advance from the customer, then there are two set of conditions. One set got 3 conditions, one set got 2 conditions. You either meet set number 1, 3 conditions, or you meet the 2 conditions in set number 2. So what are the 3 conditions? No remaining obligations, almost the entire or full consideration received, and it's non-refundable. What are the 2 conditions? The contract is terminated and the consideration is non-refundable. If you meet either 3 or if you meet either of these 2 conditions, then you can treat the advance as revenue. And if you don't meet these 3 or 2 conditions, then number 1, you need to treat the advance as a liability. Number 2, you need to keep a reassessment of para 9 conditions and the reassessment of these 3 or 2 conditions, whichever is met earlier. If you meet the para 9 conditions, you'll go to step 2. If you meet the 3 or 2 conditions, then in that case, you'll be able to treat the advance as revenue. Great. Now let's take you to a small little practical illustration on this. So I just added a small little question on this area as well to give you a good clarity of thought. So let's, I think, come to the example. Okay, so there is a question number 7 out here. Let's, I think, have a look at the question number 7. Let's read the question number 7 to you. Now we're going to apply the 3-step model, what we have learned in this particular case. Let me just read the question to you. The question number 7. This is a question which came in the education material, and wonderfully, it also came in the RTP in November 19. Many people at times ask me, so you do questions from education material. Is that really relevant for us? Well, I've seen a couple of questions coming from the education material in the RTPs and in the examinations as well. So at least which I feel, that they are relevant from the examination point of view, I've included them in the assignment. So this assignment, of course, will be shared with you. And certain questions I've given the answers as well. So that, we can have a little insight and we save time as there. So there are a couple of questions containing, so you'll get this assignment, no worries on that. So let's read the question number 7. I think I've already made a mention at the top of the question that advance has been received. It says entity G enters into a contract with the customer P for the sale of machinery for 20 lakhs customer. And this machine will be used by the customer in the food processing unit, and it is a very competitive industry, and the fellow has got a very less experience. Well, as of now, it doesn't make a difference to me. If somebody buys a machine from me and he's going to use that machine in an area where he's got no expertise, that's his problem, not my problem. So as of now, it doesn't concern me, but maybe it concerns later with more facts in the question. It says P pays a non-refundable deposit, which is 1 lakh rupee. The machine is to the tune of 20 lakhs, and the customer P Limited pays only 1 lakh against 20 lakh. That means he's paid around 5% as an advance. He's mainly paid 5%. 1 lakh over 20 lakh is 5%. At the inception of the contract, and he enters into a long-term financing agreement with the company G. The customer is entering into an agreement where he doesn't make a payment upfront. Out of that 20 lakh payments, he pays a deposit of 1 lakh rupee, and then he enters into a long-term financing agreement with the entity. That is for the remaining 95% of the agreed consideration, which it intends to pay primarily from the income derived from the food processing unit, as he lacks any other major source of income. Oh my God. This customer takes a financing from you and he lacks any other source of income. And I'm also given that he's entering into an industry which is very competitive. He's got a very less experience, and the only source of income through which he's going to pay your money is the food processing unit. Is this triggering certain thoughts in terms of para number 9? Keep writing your answer. So do you think that there is any indication that out of those 5 conditions, some of the condition is challenging? Which condition is challenging to you? You're giving a loan indirectly to a customer. He tells you, boss, I don't have any other source of income. I don't have any experience in the industry. So whatever I earn out of this industry, I'm going to repay your 95% financing out of that money. Wow. The financing arrangement is provided on a non-recourse basis. Oh la la la. This is too much. I'm yet to meet a company like this. I would wait to become a customer of such a company who finances me, and there is a non-recourse financing, which means that they cannot practically take any action against me if I don't repay that 95%. So there is a non-recourse basis, which means that if P Limited defaults, then G can repossess the machinery, but he cannot seek further compensation from P, even if the full value of the amount is not recovered from the machine. I don't know what kind of arrangement they have entered into the customer, where they are financing 95% and the customer fails to pay the money. It's a non-recourse arrangement where you cannot sue the customer for anything. You just take the machinery back and you cannot demand any further money. What a foolish deal it is. Then he says, the cost of machinery is 12 lakh rupees. P obtains a control of the machinery at the inception. So the machinery is being transferred to the customer at the very inception. When should G recognize the revenue from sale of machine in accordance with para number 9? So I think, let me read your answers, that if there is any concern regarding the parameters of para 9. Okay, I think Namrata, you said a question, commercial substance, can you explain it again? I'll do that. And Tushar tells me probability. Namrata also tells me probability. You are absolutely correct in this particular case. I think the collection is certainly not probable in nature. In this particular case, if you ask me at a contract inception that I have received out of 20 lakh, 1 lakh from the customer, rest 19 lakhs is going to be in the form of a financing agreement. The person says, I don't have any source of income. The only money from which I'm going to repay is out of this business. I don't have an experience in that industry. It's a highly competitive industry. I'll think, boss, where are you going to get the money from? You're entering into an industry which is highly competitive in nature. You've got no experience. You've got no source of income. What about my money? My collection is a question mark. Let's begin the 3-step model. So we are coming to the step number 1A, then step number 1B, and then step number 1C. Let's apply the steps one by one. So I'm just going to make a run through of my 3-step model. So just hear me carefully. You can give your inputs if you want. In terms of step number 1A, we're looking at the 5 conditions. They are not met. So one of the conditions fails, that the collection is not probable. So what do? You go to the step number 1B. Did we receive an advance from the customer? Yes, we received an advance of 1 lakh rupees from the customer. So we go to the step number 1C, since we received an advance. Now I need to understand the treatment of this advance. So I look at the 3 conditions and I look at the 2 conditions. The 3 conditions. Do you think the 3 conditions are met? One of the conditions out of 3 conditions is that you've received entire or substantially all the consideration. In this case, you received only 5% of the consideration. So you've not received substantially or all the consideration. So 3 conditions fail. Have you meet the 2 conditions in this case? Do you think the contract is being terminated? No, the contract is not terminated. So neither the 3 conditions are met, nor the 2 conditions are met. Since neither of these conditions are met, what do you need to do? You need to treat the advance as a liability, number 1. You need to evaluate the conditions of para 9 and the conditions of para 15. You need to evaluate the 5 conditions of para 9 or the 3 and the 2 set of conditions of para 15, whichever is met earlier. Isn't the life becomes simple? If you try to crack the answer on a step-by-step approach, to me, I believe it becomes life jingala. You first of all looking at the 5 conditions of para 9, they fail. You go to the step number 1B, do we get an advance? Yes. We go to the step number 1C, we look at the 3 or the 2 conditions and they fail. And then we conclude that number 1, treat the advance as a liability. Number 2, you need to evaluate, reassess the 5 conditions of para 9 or the 3 and 2 conditions of step number 1B. Whenever they are met, accordingly, we do the things. Right? I guess I am 100% clear on the things. Okay, so this is done. And that's rightly said, Namrata. Now, I think coming back to your question, you said, could you explain the concept of a commercial substance? I think, let me put it like this. Though I would not spend much time explaining the concept of commercial substance, but I think, let me put it like this. Technically, if you ask me what is a commercial substance, you're going to confront this term even in terms of Ind AS 16, Ind AS 38, and a lot of other places as well. Let me explain this in simple words. Commercial substance means that there is a change in my cash flows. In simple words, if I want to evaluate the commercial substance, I would say that is my cash flow going to undergo a change? Now remember, if I am providing goods to my customer or if I'm providing services to the customer, do you think I'm going to do it for a consideration? Yes. So do you think by this transaction, the cash flows is going to undergo a change? Of course, yes. If you're going to get inflows in terms of revenue from the sale of goods and rendering of services, the receipt of the consideration would result in changes in cash flow. So imagine that if I have incurred X rupees and I'm going to transfer it at X rupee. So is there a change in terms of inflows? No. But if you're going to buy things at X rupees and you're going to transfer it at Y, which is greater than X, that means there is going to be a change in the cash flows due to the transaction. So generally, we presume that if you're entering into a profitable transaction, that means you're selling goods at a price more than the cost. It is indirectly implied that there is a commercial substance because your cash flows will definitely improve because of that particular transaction. Right? I guess I am fairly clear on the concept of commercial substance to you. Okay, so this part is done. Now you must be thinking that we are now going to go to the step number 2 because the step number 1 is done. No, we're not going to go to step number 2. Now, in this standard, there is one very interesting thing, and that is when you're looking at the 5-step model, once you're doing let's say the first step, there are certain special issues related to step number 1. So what I'm going to do, I'm going to discuss the special issues along with the journey. It's like, you're going on a highway and you are going on a highway, but then there is a lane which comes and you feel that let me enter that city as well and let me visit that city. Then again, you come back to the highway and then again, you see another city, beautiful city on the right hand side and you say, let me visit that city as well. So in this entire journey of this particular standard, what we're going to do, we will concentrate on the 5-step, but wherever necessary, we know that there are special issues related to each step. We will get into those special issues as well. Now, in terms of step number 1, there are 2 special issues which I need to discuss with you. One is called the concept of combination of contracts, and the other is called the concept of modification. So before we go to the step number 2, we're going to discuss the 2 special issues. One is combination and one is the concept of modification. Let's begin the journey with combination of contracts. So let me just come back to a little language which I'm going to share with you. So this is on the concept of combination of contracts. Now watch me carefully, friends. There is one particular agenda which I will discuss very shortly. Maybe a question comes to your mind, maybe a question doesn't come to your mind. Even if it comes to you, don't worry, it'll get addressed. Because there is one small little thing which I'll clarify very shortly. So let me come to the special issue number 1, that is combination of contract. This is within the step number 1. We're looking at a special issue, and that is combination of contracts. Now, the question rises, what is a combination of contract? Let me make your life simple. Most of you would have studied accounting standard 7 at your intermediate level. And if you recall the provisions of accounting standard 7, there used to be a concept called combination and segmentation. So what we used to do, we used to say that, if there are multiple contracts, let's club them and treat them as one. And used to say that there is a single contract, but let's consider them as multiple contracts. So there was a concept called combining and segmenting contract. So this concept is absolutely similar, and Ind AS 115 addresses the concept of what is called combination of contract. Now, one very, very important caution. If you look at Ind AS 115, there is a para number 4 and there is a para number 17. I'm dealing with para number 17 right now, but there is a para number 4 also. Let me tell you what para number 4 says. Para number 4 talks of the concept of what we call portfolio approach. Para number 4 talks of what we technically call a portfolio approach. And para number 17 deals with the concept of what we call combination. So many times people tend to get confused. So I'm just going to first of all give you a clarification with regard to what is a portfolio approach of para number 4. Though I'm not dealing with para number 4 with you, not meant really from the examination point of view, but just to give you a clarity, there is a concept of para 4, portfolio approach and combination. Now, what is a portfolio approach? A company enters into multiple contracts with multiple customers, but all the contracts have got similar kind of characteristics. Imagine a company which is in the telecommunication sector, like for example, Vodafone, like for example, Airtel. Now they may be entering into contracts with crores of customers, and these contracts will have similar characteristics. The kind of contracts you are entering into the customers, they're all similar characteristics. Now the question what comes to the mind is that when you're applying the standard Ind AS 115, do you apply the standard to a contract wise? Do you consider that let me apply the standard to each and every contract, or do we consider clubbing of contracts and apply a portfolio approach? Para number 4 gives a company a choice. Para number 4 gives a company a choice, which means that this is purely optional in nature. This is purely optional in nature because it is a choice for the company that if they feel that they want to apply the contract, apply the standard to each and every contract individually, your choice. You want to club the contracts and treat them as one, you got a choice. So there is a choice given to the entity that you can club the contracts which have got similar characteristics. It's a pure choice. It is purely optional in nature. But when it comes to para number 17, this is not a matter of choice, it's a matter of mandate. It's mandatory in nature. Now, the question rises that when does a para number 17 gets triggered? Because para number 4 is telling you that you are entering into different contracts with different customers. Mind the words. Para number 4 is telling me that you're entering into different contracts with different customers, but they are, similar characteristic. The characteristics are common. So multi-contracts, multi-customers, but similar characteristics. So in this particular case, they say it's your choice. You want to create a portfolio approach and apply, 10 contracts clubbed together, treat it as one. It's a pure choice. But para number 17, which is on a combination of contract, is mandatory. If you fulfill the triggering conditions of para number 17, you have to club the contracts. You have to combine the contracts and treat them as one. Let's have a read. It says an entity shall. When I use the word shall, I think it is quite indicated that it is mandatory in nature. An entity shall combine 2 or more contracts entered into at or near the same time with the same customer or related party. There are 2 important conditions which triggers the application of para number 17. You got to put across 2 questions to yourself. Number 1, were the 2 contracts entered into at or near the same time? Now you would say, what does it mean at or near the same time? What does near the same time mean? There's no explanation given in the standard what is near the same time, but you need to apply your judgment that let's say you enter into contract and then again in another 3-4 days time another contract is entered into. So either you enter into 2 contracts simultaneously or there is a few days gap in terms of contract. So the first parameter is if the contract is entered into at or near the same time, and the second is it is with the same customer or a related party. Now, let me tell you one more interesting input. In terms of para number 4, the contract is entered into with different customers and maybe at different points of time. But in terms of para number 17, it is with the same customer and it is at the same time. Can you see the clear-cut distinction? So if the company feels that I have got multi-contracts with different customers, but I want to club them, you go to para number 4. But in terms of a company entered into multi-contract with the same customer at the same time or near the same time, I'm saying, boss, you need to combine. You need to combine. So combination is a mandatory exercise. So if there are multi-contracts entered into at or near the same time with the same customer or related party, you may not enter into the contract with the same entity, but even if you enter into a contract with a related party, a holding company, a parent, a subsidiary, an associate, or a joint venture, they're related parties. And accounts for the customer as a single contract if one or more of the following conditions are met. You need to meet any one conditions out of the para number 17. So remember, para number 17 has got two facets. One is, when does para number 17 get triggered? So don't worry, I'll give you notes on that. So when does a para number 17 gets triggered? So you need to remember that para number 17 gets triggered when you enter into a contract at or near the same time. Number two, you enter the contract with the same customer. It is mandatory in those cases that you need to club the contract as one if you meet any one of the three conditions. Now, what are the three conditions? Let's have a look. The contracts are negotiated as a package with a single commercial objective. You've negotiated the deal as one. How would you assess, sir, that the deal has been negotiated as one? Don't worry, we're going to see that. Then he says the amount of consideration to be paid in one contract depends upon the price of performance of the other. So there is interdependency. You can see that there is interdependency. The consideration paid in one depends upon the price or the performance of another. Interdependency can be seen. Then he says the goods or services promised in the contract are a single performance obligation. Now, what is a performance obligation? We're yet to see that. So basically, you can say that if you notice in a particular contract that there is a single commercial objective, you entered into the two contracts. I'll give you an example. I entered into a contract with a customer, contract number 1. 2 days later, I entered into another contract with a customer. And in the second contract, the customer said, no, I want a heavy discount. In the first contract, I made a huge profit. In the second contract, the customer says, no, you need to give me a huge discount. You've already fleeced me in the first contract. I also agree. Okay, let's give him a good discount in the second one. So which means that I am considering both the contracts as a single commercial objective. I say there is a huge profit in the first one, even if there is a loss, but on an overall basis, I'm still getting a profit. So what is getting met is that there is supposed to be a single commercial objective. So you may enter into a second or a third contract at a loss, knowing that you got a huge profit in the first or the second contract. So the loss of the second contract will offset the profit of the first one. So what we have in mind is a single commercial objective. Then we can see that the goods and services are interdependent. They're interdependent. The performance of one impacts the performance of the other contract. So they're interdependent, or you can say the goods are interrelated with each other. Single performance obligation, we'll understand, but it's considered that it is treated as one performance obligation. Everything is interlinked together. I think let's have a look at a case study on this. So let me just take you to a few questions I've added on this area. So this is on, yes, we got a special issue related to combination of contract. I think I'll have to just erase this as well. Let me just take it further. Okay, I think it won't go out of this. Yes, here it is. I guess let me just slightly clear this portion. So this is question number 8. We will read the facts of question number 8 to you. And let's apply the concept out here, though I've already almost written the answer on the top of the question itself. So let me just read it to you. Let me see if in the meantime you've got any questions. No, okay. So let me just, I think, read the question number 8. It says company A, manufacturer of specialized construction equipment, enters into a contract with customer B to manufacture and deliver a customized boom lift. So you've entered into a contract to supply a boom lift, and this is for 95,000 rupee. The total cost to company A for designing, manufacturing, and delivering the lift is 70,000. So you're getting a good profit of 25,000 on the deal. It says 2 days later. 2 days later means what? At or near the same time. Company A enters into another contract with B. So company A enters into a contract with B. So it is the same customer. What are the two conditions? At or near the same time, 2 days later. The contract is entered into with the same customer or related party. So both the conditions are met. The para number 17 gets triggered on a mandatory basis. Then he says he enters into a contract with B to deliver the boom lift tires that customer B will use on the customized boom lift in the future after the original tires deteriorate. The contract price per tire is 800. However, the cost of each tire is 900. The company agreed to supply the tire, which is costing 900 to the company, and they agreed to supply it at 800. They are suffering a loss of 100 rupees for each tire. So they got a loss of 400 rupees on the second contract. But they are at the same time getting a huge profit of 25,000 on the first contract as well. Do you think the company has got a single commercial objective in mind, that they are treating them as one single contract? They say that, okay, we made a huge profit on the first one, and even if we make a loss on the other one, entered into the same contract. So it is as good as treating it as one. In substance, what are you treating? The entity in substance is treating this as a single contract. So the para number 17A1 condition is met, that there is a single commercial objective. So in this particular case, we are going to combine the contracts on a mandatory basis. Okay. So here comes the requirement of the question. And I've already answered the requirement of the question as well. It says in this particular case, it says whether these contracts should be treated as a single contract. The answer, of course, is yes, because there is a single commercial objective in this particular case. Let's now give you another question. This is a question from the study material, and I think let's give you the facts and you decide the answer. I'm going to read the facts of the case. You decide whether combining should be done or not. Though I think the answer is already given in advance, that para number 17 fails in this case. So you know the answer well in advance, but still apply the inputs. It says manufacturer of airplanes for the Air Force negotiates a contract to design and manufacture new fighter planes for a Kashmir airbase. At the same meeting means at or near the same time, the manufacturer enters into a separate contract to supply parts for existing planes at some other base. So they've entered into a contract. One is for the Kashmir base, and they've entered into another contract in the same meeting, but this is meant for parts for some existing planes at other bases. Would these contracts be combined or not? Let's first of all evaluate whether para number 17 would get triggered in this case or not. Is the entity entering into a contract at or near the same time? Yes. And is it with the same customer? Yes. So para number 17 would get triggered. Do you think that these two particular contracts have got a single commercial objective? I don't think so. Do you see any interdependency or interlinking? Do you see the performance of one impacting the performance or price of another? I don't think so. Do you think in this particular case there is any kind of connection that I treat them as one single contract because it's a single performance obligation? I don't think so. So they've been entered into at or near the same time with the same customer, but still they will be treated as two separate contracts altogether. And I think it makes logical sense. I think you would agree with me on that. Okay, so I didn't get much answers on that, I guess, since I've already answered it. So anyway, so let me now document the inputs to you in para 17. Are we fairly clear, friends, with the concept of para number 17? I'll give you the notes now. So let me know if you're fairly clear with this. So let's make some notes now on the special issue number 1. That is on combination of contracts. So let's add on the inputs on combination of contracts with you. Then after this, we're just going to consolidate the inputs of the learnings today. So let's take it further. Let's give you now notes on the special issue. So this is the special issue which is related to step number 1. Special issue related to step number 1 on combination of contracts. So when I'm looking at the concept of combination of contract, let us first of all see when it gets triggered. When does the concept gets triggered? So when you say yes, we are going to combine the contracts, so when does it get triggered? So there are 2 conditions for the same. So there is a condition number 1. So there is a condition number 1 and there is a condition number 2. You need to fulfill both the conditions to trigger the concept of combination. So the condition number 1 is the contract is entered. Contract is entered. I'm putting it in capitals at or near the same time. So it is entered at or near the same time. So the gap between the 2 should not be much. It is entered at or near the same time and it is entered with the same customer. It is entered with the same customer, underline the word same customer, or related party. So either it is entered with the related party of that customer or with the same customer. So these are the 2 conditions when it gets triggered. And let's also make a mention that this is a mandatory. The para number 17 is mandatory. Brackets I'm putting unlike portfolio approach, which is optional. So just for the sake of reference, I'll just make a mention that unlike the portfolio approach, which is optional, if you want to read something further, you can make a reference to para number 4 for your additional clarity of thoughts. Okay, and then in this case, any one condition needs to be met. Any one condition needs to be met. So when you apply the para number 17, any one of the condition needs to be met. Number 1, there is a single commercial objective. There is a single commercial objective. So either we prove there is a single commercial objective or we prove that there is a single performance obligation, or we prove that the price of one depends upon the price or performance of another. It depends upon the price or the performance of another. So interdependency is what we need to prove in this particular case. Wow, so far so good. So I think this is taken care on the para number 17, friends. Let me know if you've taken a note on this. Okay, I'm just now going to spend a few minutes with you, just I think I'll last around 2-3 minutes with you, just consolidating only the issues what we have learned today. So once you just revise that in 15-20 minutes, you are able to get a complete picture of things. So we've not done much, I guess, but we just, added a few things for the day. So let me just, I think, add on what is being the learning for the day. So if you see in terms of a short mind map, what we have learned for the day, you need to be clear, number 1, on one thing, the 3 terms with which we started off. You need to be clear with the distinction between revenue versus income. A very basic thought process has to be clear that income is a wider term. That's one clarification. Then the word contract, which is nothing, but it is either oral or it is written or it can be customary business practices. And the identification, what are the two parameters that the person can be said as a customer? Basically, the person, the entity which pays you a consideration and is the final consumer of your output. The second is I gave you a very basic walkthrough. We did a very basic walkthrough, and this basic walkthrough we did on a 5-step model. So I gave you on a 5-step model what is the basic walkthrough. So you should be able to evaluate. These are the 5 steps with me. Just a little remembrance on that. Then I gave you the scope of the standard, where I think we typically had a good discussion on the barter deals, where I gave you inputs in terms of whether it is same business, same line of business, then you need to see the commercial substance, and different line of business, definitely within the purview of the standard. Then I started making a detailed walkthrough on step number 1, wherein I gave you a 3-step model in this case, where I said you need to apply step number 1A, 1B, 1C. So you need to be careful on that. And then I have covered, along with the step number 1, one special issue, which is relating to combination of contracts. So on the combination of contracts, you need to be pretty clear on the area that what are the 2 conditions which will trigger the concept of combinations. And it's a mandatory application of combining contracts. You don't have a choice, unlike the para number 4. And any one of the conditions is met, then in this particular case, you can say, yes, a combination will take place. So tomorrow, I'm going to start with another special issue to you related to step 1. That is a concept called modification, which is slightly technical in nature, but still very interesting. So today, I think it was not very technical things with you. It was just a very basic walkthrough on the basic understanding of the standard. But I think a little quick revision on your part for the 15-20 minutes is going to do wonders for us. Right, friends? So let me see if you've got any further questions to ask. Otherwise, we're going to call it a day. Any questions, friends, coming on your side? Let me see if there are any further questions on your side. Otherwise, we're going to call this a day. So please do revise what we have covered for the day, because this is going to become a base for our understanding tomorrow as well. Okay, I see no questions coming in. So thank you very much. Thank you all for joining in. So see you tomorrow back again in the morning, friends. And bye-bye and take care.